developments I've seen in my 30-plus year career on Wall Street is just this growth of the ETF business and kind of as a direct competitor to the mutual fund business, which is the business I grew up with, and those were my clients, the big mutual funds at Fidelity and so on and so forth.
I don't think my daughter's ever going to buy a mutual fund, except
maybe
a money market fund.
Exactly. All right, let's head down to Washington, D.C. right now with Get World and National News with Amy Mars.
All right, thank you, Paul. Former President Trump is predicting he'll be indicted any day now as part of the investigation into his efforts to stay in power after the 2020 election. In a Truth Social post, Trump called it an attempt to cover up allegations of bribes and payoffs aimed at President Biden and his family. He said it's election interference and prosecutorial misconduct, and special counsel Jack Smith is investigating Trump's role in the 2020 Capitol riot and repeated false claims about the election being rigged. That riot was in 2021, by the way. Trump recently shared that he received a letter from the Justice Department notifying him that he was a target in that investigation. This as a super PAC tied to Charles Koch is seeking to block Trump from the GOP nomination. Bloomberg's Ed Baxter has that part of the story.
PACs are reporting donations to the Federal Election Commission this week. The Americans for Prosperity Action reports $78 million, the bulk from $25 million donations, one from Koch Industries and the second from Stand Together Chamber of Commerce. The conservative group claims Trump needs to be stopped or Joe Biden will win re-election and could lead to losing both houses of Congress and the presidency. It has not spent much yet, but says it will. In San Francisco, I'm Ed Baxter, Bloomberg Radio.
Meanwhile, Trump's political opponent for the GOP presidential nomination, Florida Governor Ron DeSantis, is laying out his economic vision for the U.S., saying that if he wins the White House, many of those who are on Medicaid will have to get a job.
For able-bodied adults, there should be work requirements for all welfare programs.
He says his administration will curb reckless federal spending. President Biden, meanwhile, scheduled to visit 3 western states next week. He'll stop in Arizona, New Mexico, and Utah to highlight his administration's efforts to combat climate change. Global news 24 hours a day, powered by more than 2,700 journalists and analysts. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Some softer data this morning. This all supports the idea of a pause or an end to the rate hiking cycle from the Fed. Factory activity contracting in July for a ninth straight month. U.S. job openings, they fell in June to the lowest level since April of 2021. Right now, the S&P 500, 14 points lower. That's down 0.3% at 4574. The Dow Jones Industrial Average up 16 points at 35,575. And the NASDAQ 100, 48 points lower. That's down 0.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. You're streaming live on that YouTube thing. Just head over there, YouTube, and search Bloomberg Global News. So coming up, we're going to have a conversation with Sonali Basak. She sits down with Paul Taubman, the CEO of PJT Partners, one of the leading M&A bankers on Wall Street, Jess. And before he had his own firm, which is doing extraordinarily well, like a lot of the boutiques are doing. He was at Morgan Stanley for a long time running their M&A business, and just one of the leading voices on Wall Street as it relates to the M&A business. And M&A's been tough. You know, there's a lot of uncertainty in the marketplace, and that tends to lead CEOs and boards to be a little bit cautious.
Right, and also what that can say about the direction of where the economy is headed, depending on what kind of deals could be done within the next year or so.
Yeah, and the other thing is, you know, we've heard from Jen Rhee, who covers antitrust for Bloomberg Intelligence. The government's not really supportive of big M&A these days. I mean, that Microsoft deal for the Activision, 60 some odd billion dollars, that faced incredible scrutiny. So the economic environment is not optimal. The regulatory environment is difficult. It'll be interesting to see kind of what we hear from Mr. Talbot about the outlook for M&A.
PGA, Live Golf, so many different things going on there.
Exactly. So it'll be interesting to see. But he's one of the leaders, and it's exclusive to discussion coming up. So, you know, all the M&A bankers, they tend to be optimists by heart, you know.
Right.
Kind of looking at the deal flow ahead. And what we hear from the banks is that, you know, there's lots of discussions being had with lots of boards and CEOs and C-suite folks about kind of coming M&A activity.
Especially when you think about AI, with all of the hype this year. What does that mean for activity there?
Yep. All right, we're going to bring you this exclusive interview with Paul Taubman, the CEO of PJT Partners. He sits down with our own Sonali Basak to discuss M&A, AI in investment banking, and other topics. Let's bring you now to our exclusive discussion with Paul Taubman at PJT Partners.
We welcome now our Bloomberg Television audience and radio listeners. I'm Sonali Basak, standing alongside PJT Partners CEO Paul Taubman, who joins me now for an exclusive interview. Thank you for being here. It's pretty rare for you to join us for television. It's also remarkable that 8 years ago you started PJT, took it public, and now you've tripled your head count. You're much bigger than you were and are having a record half year at a time where most investment banks are facing a prolonged slump in revenue. So can you keep it up?
Well, I don't know if we can keep it up. We're going to certainly try to. But first of all, thank you for having me on this morning, Sonali. It's great to be here. It's almost 8 years, as you point out, and we have a plan, and we're just moving forward with the plan. But if you look at our first 6 months, it was driven by, we have a leading restructuring practice, and we're increasingly taking share from others, and we're trying to get at the forefront of liability management, trying to work with companies to re-equitize and restructure their balance sheets and deal with the fact that interest rates continue to grind higher. And we're growing out a leading strategic advisory business that's still in the early innings. So even though we're dealing with a lot of the same macro headwinds that others are, we're able to gain share and continue to move forward, you know, and continue to advance our position.
You know, we'll talk more about that restructuring wave because seriously, these idea of higher interest rates are going to have some impacts over a long period of time, but also remarkable is that you're hiring. You are hiring at a pretty rapid clip at a time when most investment banks are letting people go by the tens of thousands. How significant are your hiring plans this year?
Oh, they're quite significant. So if you take a step back, we have tripled our headcount in 8 years. We've tripled the revenues. Share prices up nearly 4 times. And if you look at the size we are today, we're still a half to a third the size of many of our direct competitors, and we're a fraction the size of the large banks. So we see tremendous opportunity to grow. This is an incredibly conducive environment to grow. You need to see M&A slow down in order to hire the best M&A bankers, and that's the ultimate paradox. And the reason for that, Shonali, is because the switching costs are much lower when you're dealing with a low velocity environment. Trying to get a best-in-class M&A banker to leave in the midst of an M&A bull run when they're loaded up with a whole host of mandates, the switching costs to extract themselves, they end up leaving their clients in the lurch. So we're taking advantage of the fact that even though the environment is quite challenging in the near term, we know it's going to inflect, we know it's going to come back, and we want to continue to press forward and continue to grow the franchise.
Is this going to be a record hiring year, and can some of this momentum continue even into next year?
Well, it's certainly going to be a record, and we intend to continue to press forward. Now, how many individuals we attract to the platform, really, we don't control fully, because at the end of the day, we have a very clear sense as to who would work well on the platform, who's best in breed, who's best in class, who shares our vision, shares our values, and you cannot end up, turning this into a quota as to how many you hire each year. But there's no doubt that we're still relatively small compared to the opportunity set. So if you ask me, are we going to be much larger 3-5 years from now? The answer is absolutely.
Bring us under the hood, because it's a pretty fascinating dynamic. You have such high-profile bankers leaving Goldman Sachs and Credit Suisse, all for different reasons. And so what are bankers telling you as you're having these conversations?
Well, if you step way back, there are a few trends which have been in evidence for the last decade. The first is that increasingly clients want to work with smaller firms. And we started to see that coming out of the global financial crisis. That's only picked up speed over time. So that's the first point, is you need to have buy-in from your client base. I think the second, which is a corollary trend that most individuals didn't really pick up on, is if the most sophisticated, consequential companies around the globe are going to work with smaller firms, they're going to expect the sophistication of a larger firm. So that means you need to continue to build out the breadth of services, the caliber of individual. You need to make sure that you can follow your clients anywhere around the globe. So those two things have continued to prove out. And as bankers at bulge bracket firms increasingly see that their clients would be highly supportive of a move to a smaller firm, the question becomes, what's the catalyst? What's going to get you out of a comfortable position to take a jump, take a leap, do something different? And I like to say that we're in that exquisite sweet spot, which is we're big enough so that no one's going to miss a beat. They're going to have access to working with some of the most sophisticated colleagues around the globe. But we have so much white space that they can get in early, not be jockeying for position, and do what they love to do, which is be bankers, not managers.
Speaking of being a banker, bankers have been griping a lot on Wall Street.
Always
About everything. But, when you think about what they're actually talking about now, it's return to work. How often do they have to be in the building, and how flexible do you have to be to keep them around?
Well, that's a great question. I made a commitment in the depths of COVID of two things. One was we were learning so much from how to work remotely that we were never going back precisely to how we did work pre-COVID. On the other hand, if you're not in the office most of the time, and if you're not creating those personal connections, and if you're not learning through an apprenticeship model, you're not doing it the right way. So what we've been continuing to evolve to is a model which starts with being in the office, because that's where you learn, that's the best way to support the clients, that's the best way to train and develop individuals, and there's no latitude for people not being back in the office. Having said that, you can't allow technology to continue to invade your personal space, be on call 7 days a week, be expected to get on a Zoom call on a moment's notice, and not have some release valve. So what we did about a year ago was we turned Fridays in office to be optional. You could work from home on Fridays, but work from home starts with work. You may be home, but you're working. And in the dog days of summer, which is after the summer interns leave until Labor Day, we also have a work from home option. And I think by acknowledging that we can use technology to be more productive, but making the centrality of being in the office, we can try and find that sweet spot.
It's about to get busier slowly after a big deal slump. How fast do you actually expect mergers and acquisitions to start coming back to the market?
The pace of activity and dialogue is clearly picking up. We're looking at levels today that we haven't seen in more than a decade. So M&A volumes today are not much greater than they were coming out of the global financial crisis. If you benchmark it relative to GDP or market capitalizations, it's at lows we haven't seen, I think, ever. So I'm not really going out on a limb by saying it's going to get better from where we are today. There's no doubt about that. It can't get worse. There's an old saying, you can't get hurt jumping out of a basement. I don't think, we are in danger of going lower than where we are today. The question is, how quickly does it inflect? And one of the things about M&A is it's a pro-cyclical business. Transaction activity begets more transaction activity. There's the ultimate FOMO, fear of missing out, which is if your competitor is transacting, if they're growing, if they're investing, if another private equity firm in the alternative space is committing capital, it tends to lead to more activity. I think we have the conditions that are nearly ripe for that, and it wouldn't surprise me if sometime between now and the end of the year, you see a very sharp inflection.
There is one place things could get worse, that is with restructuring. Higher interest rates, a whole bunch of forces that are pushing companies to either restructure or go bankrupt. How significant is this wave of distress going to be? What does it look like?
Well, I think we're in for an extended wave of elevated restructuring relative to where we are today. But where we are today is at historic lows in terms of default rates and the like. We're still feasting off of, the easy money environment, relatively low interest rates, but there's a day of reckoning, and we're going to see a meaningful uptick in restructuring activity. But again, to put it in perspective, that's relative to historic lows. And I often get asked the question, can an upswing in M&A coexist with an upswing in restructuring? And my answer is pretty simple, is right now, they're both at historic lows. We're seeing historically low default rates, and we're seeing historically low M&A volumes. And I think both of them can sort of snap back more to traditional long-term levels and both start to be engines for our firm.
Now, Paul, before you left and started PJT, you were very senior at Morgan Stanley. You were seen as the CEO candidate. Now, fast forward more than 8 years, and you have Morgan Stanley going through its own CEO transition. What do you think the future of Morgan Stanley looks like?
Look, I think James has done a terrific job. I think the firm, is firing on all cylinders, notwithstanding the difficult macro backdrop, and I have no doubt that they'll continue to thrive going forward. I think the question for our firm is what do we do and how do we thrive going forward? And I'm confident that we have so much open running space ahead of us that that's what I'm focused on. That's where my attention is.
Are you thinking about number 2 already?
I'm always thinking about succession. I'm always thinking about, who's going to succeed me, because we're building this firm to last, to be durable, to be sustainable. And that means that you need to be able to train, develop a next generation. Most of our growth has come from external candidates, but that's reflective of the fact that we're only 8 years old. But the goal is over the next 8 years, as more and more of those individuals who join at the most entry-level positions, they get to grow up in our firm. They're trained, they're developed to be the world-class banker, and they have only one home, and that's PJT. So that's what I'm focused on.
Speaking of, this is the last week for the interns. The interns are starting to, leave Manhattan now and all the cities they're in. Do you have any advice for them? Because there is a lot of anxiety about what jobs they can get coming out of these cycles.
Well, it's crazy. We have at our firm nearly 100 summer interns around the globe. And that's about 1% of the resumes that we get. We get close to 10,000 applications every year, and about 100 show up at our firm for the summer. And one of the things that we've initiated, which I think is terrific, is that at the end of the program, every one of our interns is obligated to then spend time doing community service in a project of their choice. And to me, that's one of the things that I would tell everyone on Wall Street to take away, which is you can go at it really hard, be very focused on your career, but there's a bigger world out there. You're part of a broader community, and find a way to do something to give back to your community.
Bankers are people too, right?
Yes, absolutely.
Paul, thank you so much for your time. It was great to sit with you and such a rare interview with you at a really historic time for your company, so thank you. That is Paul Taubman. He is the CEO and founder and chairman of PJT Partners.
All right, Shonali Basak, great exclusive interview with Paul Taubman. He is the CEO of PJT Partners. You don't get to really hear from him too often, so it was a great to listen to Shonali have that conversation with Paul. He, again, one of the leading M&A bankers on Wall Street with his own firm, and before that, a leader in the investment bank at Morgan Stanley. So one of the leading voices on Wall Street. So it's good to get some of his thoughts. We also had a lot of economic data today, Jess, and the ISM manufacturing data came out. A little bit weaker than expected, but showing some growth, some improvement from the prior month. Let's break it down right now. Tim Fiore, he is the chairman of the Institute for Supply Management Business Survey. He joins us here. Tim, give us kind of your thoughts here on what we saw from some of the data today. Oh, Tim, I think we got on mute. There we go. No?
Hi, everybody.
Okay.
So, really interesting report. You know, I think we might be in the trough or entering the trough period. If you look back the last 3 or 4 months, we've been hanging around 46 and some change from a PMI level. But even more importantly, the 5 sub-indexes that make up that PMI have shifted fairly substantially. So first off, on the demand side, our new order level and our backlog did not contract as fast as it has been contracting over the last 3 or 4 months. So there's some sign of life there. We're not expanding yet, but the new order level came in at 47 and some change. The backlog climbed above 40 for the first time in a long time. So that's really positive. The biggest story, I think, in the month of July is that production did adjust downwards, not as significantly as it did in June, but it still came down to really align with expectations for half two. And then most importantly, I think the employment numbers saw a fairly significant hit here as companies destaff their factory floors consistent with that half two demand. So we were expecting that back in May. There was signs that it was showing up. In June, more signs. In July, for sure. You know, I track the hire fire ratio, force manager ratio, and I've been tracking the layoff piece. And last month, the layoff piece was a more significant percent of the attrition, freeze, layoff, triumvirate. But in the month of July, all 3 of them were used relatively equally, and more of them commented about all of those 3 actions that I've seen since I've been tracking this. So I think companies are destaffing, consistent with the forecast for half two. I don't think that forecast is really dramatically down. There is some life on the demand side. I'm hoping that in the next couple of months we'll see new order levels come back up. I'd like to see backlog grow again. And on the input side, it remains accommodative. And you can see the prices number, although it didn't contract as much as it did in June, is still contracting fairly heavily at 42. So, you know, there's 5 things that I've been tracking now for about 6 months, looking for signs of life. In the month of June, only 1 of those had a sign of life. In the month of July, 3 of those did. And, you know, one of those is we had 91% of manufacturing industry participation contracting in July, which was up from the high 70s in June. But most only had 25% contracting at 45 or less, which is down from 41% in the month of June, which I think is really positive. The only couple of indicators that I'm watching that didn't show any movement from a positive standpoint, transportation still remains very accommodative. You can access it. It doesn't cost you a fortune. And our lead times are stubbornly stuck, and I think manufacturing companies are just going to have to deal with that longer lead time.
Hey, Tim, thanks so much for jumping on with us. Appreciate getting your quick analysis there of some of that manufacturing data. Tim Fiore, he is the chairman of the Institute for Supply Management Business Survey. Again, seeing contraction in ISM manufacturing, that data point came in at 46.4. Anything below 50 means manufacturing sector is contracting. Anything above means it's expanding.
9th straight month that it was below that threshold. So that was the longest streak since 2007, 2009, obviously during the global financial crisis.
So to me, that's a manufacturing recession.
Yeah.
But as Tim suggested, it was above where we were last month. So a little bit of a positive momentum, perhaps a building there. So, but again, a cautious tone from the manufacturing front for the back half of this year is what we heard from Tim Fiore. S&P 500 off 0.3%. The Dow Jones Industrials unchanged. NASDAQ off 0.4%. More markets now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Oh, thank you very much. Thank you, Jess. Good partner there. All right, coming up in this hour, we're going to break down the earnings from Caterpillar. The stock's up 7.2%, so the street likes it. Chris Cialino, he follows the stock for Bloomberg Intelligence. Plus, we're going to talk to Neil Grossman, former CIO, TKNG Capital. He's one of the smarter folks that we speak to. He's going to be in studio. He's also a producer of some fine New York State wine, so we can talk about that as well. Plus, Nimrit Kang, co-CIO and senior portfolio manager at North Star Asset Management. We're going to check in with her and get her market call. But first, let's start this hour off with a Bloomberg Business Flash with John Tucker.
All right, Paul and Jess, first trading day of August. The major stock average is mixed right now. Dow is higher. That's getting a lift from Caterpillar at their earnings report. And then you have Amazon, Tesla, and Apple. They are all lower right now, and that is helping push down the S&P 500 as well as the tech-heavy NASDAQ 100. Over at JP Morgan Securities, Elise Hussenbach says stocks can continue to move higher.
We do think that this rally can start to broaden out, and that's a big reason why we've been encouraging investors to focus on the other 493 names in the S&P 500, which, taken together, are actually still trading at a valuation below their 10-year average.
And then you have Treasury yields. They are up right now. 2-year is more reactive, so that's up 1 basis point. 10-year, 8 basis points higher. It could be a reaction to the Treasury issuance, the current quarter issuance. That's expected to exceed $1 trillion. So that's bucking the trend against the data, the softer data that we saw earlier this morning. And then you have JetBlue Airways slashing the full-year profit forecast. They see signs of a slowdown in domestic travel. And that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, good stuff. Thanks very much. We appreciate it. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio, and we are streaming live on YouTube. Just head over there and search Bloomberg Global News, and that'll take you right to the programming. Caterpillar, our good friends, they reported some good numbers last night. Stock up over 7%. Caterpillar based in Irving, Texas. Joining us, Chris Cialino. He follows the stock and all that construction industry stuff for Bloomberg Intelligence. Hey, Chris, talk to us about Caterpillar. What did the street like here?
A lot. It was a really impressive quarter with pretty significant top and bottom line beats, really driven by strong pricing and better than expected volume growth, due in part to some dealer inventory restocking, and really just continued strong execution as the supply chain continues to normalize. We actually saw enterprise margins strengthen sequentially in the period, which is kind of counter to normal seasonality. But I think kind of beyond the stronger operating performance, both orders and backlog improved in the quarter, which was a little bit of a surprise to us, and retail sales accelerated. So I think that alleviates some of the concerns investors have around the cycle peaking here.
Yeah, that's kind of where I wanted to go. I'm looking at the stock hitting an all-time high, so that's good for shareholders. Then I look at the ANR function, analyst recommendations, 12 buys, 14 holds, and 3 sells. Half the analysts on the street missed this run here, this all-time run up to an all-time high. What's the concern if the business is so strong?
Yeah, the concern is really how sustainable are these results, right? Is this as good as it gets? We're posting margins, above 20%, which they haven't done before. Margins are going to be at the high end of their long-term framework. We have a record backlog. Pricing is phenomenally strong, but that will moderate in the back half of the year. Dealers will start to destock in the back half too. So I think the concern is this sustainable? I think this quarter was kind of a step in the right directions, and I think we're looking at probably a structurally higher return business cycle over cycle. But the concern is if we're not at peak, we're probably pretty close.
And whenever I think of Caterpillar, obviously I think of those yellow bulldozers, but also the world's biggest producer when you are thinking of heavy machinery. Can you really have a global recession with the way Caterpillar is performing at this point?
Yeah, so there's certainly puts and takes to that. If you think globally, I mean, you know, North America continues to be very strong. Europe has hung in there, although it was a little bit weaker in the period. China, which is the largest construction equipment market globally, continues to deteriorate, took another leg down in the quarter, which really wasn't a surprise. We kind of expect that to bounce back next year. So there's a lot of moving pieces, geographically speaking.
All right, so I'm sorry.
I was just going to follow up on that because the CEO of Caterpillar actually said during the earnings call that the company does anticipate further weakness in sales of the machines used specifically in Chinese construction projects. So I would imagine when you're hearing something like that, what kind of indicators are you honing in on to see what that could mean for the company and obviously how that could potentially translate to its peers as well as what that means for the economy?
Yeah, so we've seen a lot of the macro indices deteriorate over there. We've actually had a number of machinery companies globally report. So we kind of had an inkling that China was weakening throughout the quarter. But in the big scheme of things, remember, you know, China historically in a normal year is 5 to 10% of consolidated revenue. We're looking at a second year down with pretty significant decline. So it's going to be less than 5% of their total business this year.
All right, so Chris, I hear my president talking about infrastructure. I hear members of Congress talking about infrastructure spending. I mean, it sounds to me like, at least in North America, there's several years of growth ahead for this industry. And for CAT, what does the company say about that?
Yeah, so they are starting to see over the past few quarters some of that infrastructure funds flow. And you're right. I mean, we have an immense amount of fiscal stimulus coming through the pipe here. So I think you're probably looking at a more resilient CAT through the next downturn, just given the sheer vast amount of money that's going to be coming through. You're really not seeing customers in any kind of financial distress. They're in healthier positions compared to other prior downturns. The services business continues to grow. So I think this helps offset some of maybe the cyclical weakness that will probably start to creep into the business next year.
Talk to us about the cost-cutting efforts the company's gone through, and how does that translate to its margins and potentially its stock price as well?
Yeah, so if you think about in the prior downturn, CAT did a phenomenal job of taking a lot of structural costs out of the business. They run at extremely lean levels compared to a lot of their peers, which is why they're able to put up best-in-class margins. We're looking at probably margins, pushing up close to operating margins close to 20% this year, which would be a record for them.
Who does Caterpillar really compete against on a global basis?
If you think about it, it's a very consolidated market. Komatsu is probably their biggest competitor, both on the construction and the mining side. Mining is essentially a duopoly with Komatsu and CAT. When it comes to construction, there's other peers. Deere has a growing presence in the construction market. They made an acquisition of Wirtgen a number of years back to kind of expand their global breadth. CNH Industrial, a much smaller competitor on the construction side, Volvo. And then you have the number of regional competitors over in Asia.
All right, great stuff as always. Nice getting an update on one of our favorite companies, Caterpillar, Irving, Texas, construction equipment. Chris Cialino breaking it all down for us. He covers all those industrial things for Bloomberg Intelligence, joining us from Princeton, New Jersey, the global HQ, if you will, of Bloomberg Intelligence. That's where we founded this thing, down in Princeton, New Jersey. Nobody's bothered us. Nobody knew we were there. And now we're 400 strong all around the world, and they can't get rid of us. We're just too big. All right, let's switch gears. Let's take a look at this market here. I don't have a lot of direction in the market today. S&P off about 0.3%, but I've got a lot of economic data coming out this week. The market also has a lot of earnings it continues to digest. Let's check in with Nimrit Kang. Nimrit is the CIO and Senior Portfolio Manager at North Star Asset Management. Nimrit, thanks so much for joining us here. Boy, 2023 has been so much better than 2022, where you hide anywhere last year. How are you guys positioned coming into this year, and maybe how has that changed since boy, markets have had such a good first 7 months of the year.
Yeah, no, thank you for having me, and thank you, Paul, for that question. Yeah, 2023 has been a surprise to everyone. Coming into the year, there's been widely expected calls of a recession, economic slowdown, which is still missing in action. The economy is pretty resilient. As we came into the year, we have been very concerned about the long-term outlook. And the reason we say that is there are a number of trends that are coming together, Paul, which over the medium to long term, we think means higher volatility and higher uncertainty in the markets. And let me just take a step back into why we say that. It's a convergence of a number of mega trends that have been in making for a long time. The number one thing that we see is there's an end to the cycle of almost like a decade of easy money, zero interest rates. All of a sudden, we are contending with higher interest rates, tighter credit conditions. But then you overlay that with some of the longer term problems, such as all the things that we're seeing related to the ecological changes. I mean, you have heard, we have experienced it ourselves, extreme weather, extreme heat, floods, droughts. All that means is that we just don't know where the next shock is going to come from. All kinds of bottlenecks that we have to contend with. And then, there's increased social polarization and increased political polarization. All of that. And now we're at this very special inflection point for the artificial intelligence technology and how that's being disseminated and rolled out. And is that going to just widen the divisions that we have in our society? All those things, when we combine them, yes, the economy is way more resilient than anybody expected in 2023. But longer term, that just tells us that we really need to be laser focused on managing risk for our client portfolios.
Nimrat, with that type of backdrop in the economy, how are you positioning? What are you buying? What are you selling when it comes to being a portfolio manager and managing that money for your clients?
Yeah, absolutely. So for the equity portion of the portfolio, the best way we can manage risk for the client portfolios is to focus on high quality stocks. High quality stocks which are trying to solve long-term secular problems related to water and resource efficiency, related to aging demographics. Those are the things that we're really focused on. Well, high quality companies run by very strong managements that are good stewards of capital and labor and are adept at responded swiftly to any kind of changing trends that happen, be it supply chain bottlenecks or anything else that might come up on the horizon.
What particular industries or sectors, can you get into that to be more specific?
Yeah, absolutely. So some of the companies that we really like a lot are the ones that are actually solving these problems related to water and energy efficiency. Some that come to mind right away are like a Schneider Electric. It's an European company based in France, one of the largest electrical products companies. And Schneider makes everything from switchgear, circuit breakers, power automation. They're providing products and solutions that are helping save energy energy usage for companies, for buildings, for industrial processes. So that's a stock that we like very much. Similarly, there's Eaton PLC. Eaton actually provided their results this morning. Again, double-digit growth in revenues, record margins, very strong backlog. Again, very much driven by the same secular trends in decarbonization and increasing use of energy efficiency products. Because we're having this huge transition to a sustainable infrastructure, more demand for renewable transition to renewable energy sources and so forth. And lastly, I will give you another small stock. Actually, it's a company based in Milwaukee, Wisconsin, and it's Badger Meter. And they make water meters, fluid meters, and their customers are utilities, municipalities, other type of businesses that are very focused on conserving water and providing high quality and pure water for customers. So again, they're seeing record demand for their products and solutions as the demand for these types of products continues to grow.
So Nimrat, when you look at across your portfolio, are you guys What's your weighting, equity versus fixed income today, and maybe other assets versus maybe a more normalized time? Are you overweight equities, underweight equities? How do you think about that now?
Yeah, absolutely. So one of the first things I'll say, Paul, we're the first to admit on the fertility of the short-term macro forecast, right? So we have a strategic asset allocation for equities and fixed income. And even though we have been coming into this year, we were slightly underweight equities versus our strategic allocation target. One of the things that our client, the equity portfolio has done quite well because of the types of companies that we own. But looking forward, I think for us, we really don't want to get too worried about the tactical calls on equities versus fixed income. Fixed income is a very viable alternative for our clients now, much more viable than it has been for years. So with a higher yield, so that's definitely close to our strategic weight on the fixed income there. And for equities, even though we don't see a major dislocation where we need to be overweight or even at benchmark, we want to have that dry powder available in cash, and especially with the money market yields where you see them today. We want to have that a small cushion available so that if there is a dislocation, we can continuously add that exposure.
You said money market funds, something Paul and I discuss often. Is it just as simply what you can yield in that space? And if so, what's the catalyst for you to move that money toward equities?
Yeah, Jess, it really comes down to, constantly we're evaluating the risk reward, right? So when we talk about being very risk aware, we're really focused on making sure that, what's the better alternative? So for the money markets as a cash alternative has been yielding 4.5% higher than that. That's a pretty nice yield. So, the catalyst to move that into fixed income would be if we start to see if we can lock in higher yields than that over longer periods of time. That's always a catalyst. And then on equities, if we see a major dislocation. So just to give you an example, some of our technology stocks, as you know, the rally in the S&P 500 and the major indices has been primarily driven by the Magnificent Seven so far. So, and we've owned several of these stocks into this year. We will continue to own them because of the long-term growth outlook, but we are rebalancing. We are taking profits on those stocks and putting them into some of the laggards for the year. So we will continue to take those opportunities, but we need to see a major dislocation in equities to start moving the cash buffer over to equities.
Hey, Nimrit, thanks so much for joining us. Nimrit Kang, CIO, Senior Portfolio Manager, North Star Asset Management, getting her call on this market that came in a little bit underweight this year. More coming up. This is Bloomberg. All right, let's get some company news right now. Steve Rappaport.
Paul, BP raised its dividend by 10% and says it will buy back another $1.5 billion in shares, even as profit fell more than expected. CEO Bernard Looney tells Bloomberg margins were weak in diesel, but other areas fared better.
We're seeing very strong gasoline and very strong jet fuel demand. People are traveling, people are spending on services, let's say.
Looney also announced BP intends to bring on 200,000 barrels a day of new production between now and 2025.
Steve, more than 150 chapters of the Teamsters signed off on the $30 billion deal, clearing the way for members to vote starting Thursday. The contract provides raises for all workers and eliminates a two-tier wage system that the union said permanently divided workers. Teamsters President Sean O'Brien touted the tentative agreement as more far-reaching than any settlement ever negotiated in the history of American organized labor. Members who opposed the deal argued the union could extract more concessions from UPS in an era of record profits. Steve?
Jeff Bellinger reporting on UPS moving closer to finalizing a new contract with unionized workers. And Tesla is seeking nearly $100 million from the U.S. government to build 9 electric semi-truck charging stations. According to emails seen by Bloomberg News, the charging points would be on a route from the southern border all the way up to Northern California. Tesla stock currently down more than 1.5%. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney coming up after this.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The Dow's been bouncing between gains and losses. On the plus side, you have Caterpillar higher after its earnings report. Then United Healthcare, that's proving to be a drag right now. United Health being sued by the U.S. Labor Department. This comes over emergency room claims denials. And among the data out this morning, softening in demand for workers. That was indicated by the JOLTS survey, and the ISM prices paid index coming in lower than expectations. And then you have Uber reporting its first ever operating profit, but the shares were lower. Wall Street questioning whether the company can maintain the pace of its growth. S&P 500, 17 points lower. That's down 0.4%. The Dow right now 16 points lower. The NASDAQ 100 is down 50 points. That's a decline of 0.3%. Here's a question. I guess this is going to go to Jess, because I bet our guest Neil knows.
Yep.
Paul, I'm guessing you know. Who were the Magnificent Seven in the 1960 movie, pardon me. Do you remember? It is based on a movie, which is actually based on the Seven Samurai from Kurosawa. But do you want to take a crack at it? Yul Brynner.
I don't know.
Steve McQueen.
Clint Eastwood.
Ah, okay.
No, it wasn't Clint Eastwood. Robert Vaughn, Charles Bronson again, James Coburn, Brad Dexter, and Horse Buckles.
I would never have gotten old
Horse Buckles. Anyway,
that was my next
with all the
guess.
talk about the Magnificent Seven, had to clear that up. Anyway, that's your
Glad we took care of that one.
Business Flash.
All right, John Tucker, thank you so much, I think, for that. Let's check in right in with our next guest, Neil Grossman, former CIO at TKNG Capital, is a founder there. Neil, when we have you in, we appreciate you taking the time coming into our studio here. We're on streaming YouTube, so be on your best behavior. What do you want to talk about? I mean,
so many places we could go here.
Well,
yeah.
Let's talk with the unemployment data that's coming up on Friday, because I think, at the end of the day, this seems to be the primary focus of where the Fed feels it's lacking its outcome. This is could be an absolutely wild number. Most people don't know how wildly the statistics can be, and in July and January, the U.S. economy has traditionally lost enormous amounts of jobs. January, 3+ million, and in July, traditionally about 1.1+ million. The aftermath of COVID has totally changed the behavior so far, and the statistics are not really fully caught up. So, for example, 3 years ago, the July number was actually a gain of about 600,000 jobs. 2 years ago, I believe it was rightfully zero. Last year, it lost about 340,000 jobs in July. Those are still way, way, way below what is traditional, whereas the BLS and its expectations, even last year, were still on the order of 800,000 plus job losses. So you saw a number print of about 550,000, if I recall correctly. Mm-hmm. The question is, what is the BLS adjustment relative to this shift? Are they going to still look for very high numbers of unemployment? And then what happens vis-a-vis the actual job numbers? Have we moved into a totally new era where the economy is losing or between 0, say, and 400,000, or are we beginning to migrate higher towards what were more traditional numbers? And where those two meet make it hard. So, for example, if the economy actually lost 600,000 jobs this month, which would still be traditionally a super number, even relative to last year, wouldn't be much of a change. But if the BLS is now looking for 600,000 job loss, the headline print would be 0. And so we're in a very strange, and it's going to continue this way for a while as we sort of unwind the effects of COVID.
What is it about July in particular that you would see that historical pattern?
Well, traditionally, there were things like teachers going on sabbatical, leaving for the summer, retiring. The automotive industry used to have enormous numbers of furloughs in July, which, because of Michigan law, were treated as layoffs so they could get actually paid unemployment. I'm sure there are many others. So that was the tradition. Now, I don't think the
auto sector is laying off many people at this point, and even if so, I think they've spread them out a little bit. So that's not really happening. I'm not sure what's happening in the teaching profession. On the other side of the coin, you also tend to have a lot of summer jobs, and the demand for travel and leisure and those related industries are still off the chart. So if you look at the claims numbers, they're actually starting to improve. I'm not sure what ADP is going to bring tomorrow. We'll see. But the more short-term anecdotal, non-adjusted data would suggest that we should see a reasonably good number. I'd also be looking for what the wages are saying, as well as the work week. Wages are worrisome. I think the Fed should be very worried about that. Even though the ECI was a bit softer, the bottom line is that you see these wage settlements, and they are enormous, and they don't go away. Right. Even if the inflation goes down, you'll never see any of these, these contract negotiations.
All right. So, per Gina Martin Adams, our equity strategist at Bloomberg Intelligence, we're 3 quarters into an earnings recession here. This is the 3rd quarter in a row of negative earnings growth. Are we in an economic recession, or are we going to see that, or is that off the table now?
Well, again, interesting question. So, how do we report GDP? We report a real number, which is the nominal less inflation. Nominal has been slowing. I haven't seen the most recent quarter, but inflation's fallen a lot. So the fall of prices is offsetting, and in fact probably more than the fall in GDP today, nominal. So the number's still positive. I think, and Paul, I think we talked about this last time. We're either last month or this month will be the end of the really good year-on-year comparisons on both core and headline CPI, and the rest of last year was extremely weak. I mean, I think the headline averaged about 0, for example. You're seeing upward pressure on oil. It's up, 10%, 12% in a month. You're seeing upward pressure on other commodities, softs, and things like that. I think there's and again, I apologize, I think we discussed this last time, that we're going to move into the fall where there's upward pressure in the various components of the goods sector. You're seeing upward pressure on wages. Yes, I know that there are some features of the core, like, the housing numbers, which are expected to start to subtract. But I think there's a very significant risk that you start to see prices rise. I don't understand why anyone thinks the Fed has any reason to cut. I mean, the economy is performing quite well with these interest rate levels.
Did they hold here, do you think?
Well, there's no reason to cut in the absence of something. I actually think this economy has performed better at these levels, in a sense, than they do at 0. And so, we'll see where it all settles out. But if you think about it, where we sit now with the equity market, oh, by the way, that was the other thing. The equity market's reliquefied, so there's also theoretically upward pressure coming on prices and goods just because of how the stock market's doing. I think the only reason that anyone would think of cutting interest rates, given the other data, is the stock market takes a nosedive. I mean, it's very expensive, but that's not a reason to cut rates at the end of the day.
Talk to us about the dollar. So looking at the Bloomberg Dollar Spot Index, that's down close to 10% since peaking in September. But obviously, when you're thinking about multinational companies, which compose more than 1/3 of the S&P 500, I mean, so far, if you're looking at the latest growth with about more than 60% of the market cap in the S&P 500 reporting, still close to down to 9%. And if you look year over year, what do you think the dollar is telling us?
Well, a couple of things. Number one, the dollar is telling us that some of those earnings are actually not as good as you'd think they were. Of course, I think we were discussing this a few moments ago. Companies are really quick to blame a strong dollar for hurting their earnings, but you never hear them mention the fact that a weak dollar is good for them. Look, there's the non-domestic economy is not done as well as the domestic economy. So U.S. goods and services are not, necessarily being purchased. China and Japan, well, Japan's going to be a really interesting situation, but a lot of the demand for, U.S. assets came out of currency accumulations in those economies, and those economies, particularly China, as we know, has been very weak. So less demand for dollars or offset for that is not so surprising. Oil rising is also not usually traditionally good for the dollar either, although I think we are nowhere near as imbalanced on our energy demands as we were, say, 15 years ago.
Something I'm curious about, because we've seen growing optimism among strategists on Wall Street, especially this morning. We saw Oppenheimer Asset Management. They looked at their target for the S&P 500 to 4,900, which is above Tom Lee's at Fundstrat. Believe it or not, the perma bull there, but also Mike Wilson still has the same price target around 3,900, but obviously admitting they were wrong. What is your take? We only have about a minute left, but as far as when it comes to strategist capitulation, at what point does the pendulum swing to where it can be a contrarian indicator for the stock market?
It may well all be. To me, 4,940, that was a rounding errors, to be very honest with you. I think the stock market is very, very expensive. And again, if I'm right about the price pressures, you're going to be moving into a period where prices are going to be making the Fed's position more and more difficult. If you do see slowing of the economy, the slowing of employment at the same time, it's really problematic.
All right, real quick, 30 seconds. What are you drinking right now?
Oh, good Burgundy, good Pinot.
Yeah,
is number one. Rosés have been good. I'm not a big rosé fan, but if you get a good rosé in this heat, it's not been terrible either.
All right, so the grapes are doing okay?
Not this year.
Not this year.
Would you believe we had a 21-degree night in late May? So it's very, very bad for grapes.
Oh, no.
Poor grapes. Neil, thanks so much for joining us here. Neil Grossman, co-founder of TKNG Capital, joining us in the Bloomberg Interactive Broker studio, talking about markets, talking about macro, talking about grapes and wine.
I hope I can get some wine sometime from, I just heard about this, that
he
gives these to you.
Absolutely. He's very generous, very generous. We appreciate Neil bringing that in.
I'll be leaving early today to have a liquid lunch, I think.
That's what we like to hear. All right, let's head down to Washington, D.C. right now. We're going to get world and national news with Amy Mars.
All right, thank you, Paul. The federal grand jury hearing evidence on Donald Trump's efforts to overturn the 2020 election could soon return an indictment against the former president. The grand jury is meeting in Washington, D.C. today, after Trump this week predicted charges would come any day now. This as the Fulton County, Georgia district attorney announced that after 2.5 years, her work is done. President Biden may be facing a warning sign for his campaign in the state of Georgia. Black voters there are sounding lukewarm to the idea of a second term. They're citing inflation and setbacks on policies like student loan forgiveness. Bloomberg's Jody Schneider reports the president is planning to send a more positive economic message.
This is, getting on the ground, retail politics, trying to make the case that the economy, that things that the Biden administration has done and is doing will help black voters and going out there making their case.
Bloomberg's Jody Schneider reports 88% of black Georgia voters supported President Biden in 2020, but he won the state by less than 1% overall. A settlement in a 2-year-long legal battle over profits from a line of cancer cells derived from a woman in Baltimore, Maryland, more than 70 years ago. Ben Crump is the lawyer for the Lax family. He says the settlement with Thermo Fisher Scientific came through on what would have been Henrietta Lax's 103rd birthday.
Some measure of respect for Henrietta Lacks, some measure of dignity for Henrietta Lacks, and most of all, some measure of justice for Henrietta Lacks 70 years later.
The so-called HeLa cells were taken from Henrietta Lacks, which developed vaccines for polio, treatment for Parkinson's, leukemia, AIDS, and cancer. Terms of that settlement are confidential. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The stock rally that catapulted the S&P 500 to a 6-month high, losing some of its momentum today. The major averages lowered to little change. Among the earnings, you had JetBlue, that sank after slashing the full-year profit forecast. Norwegian Cruise delivering an earnings guidance that's trailing the average analyst estimate. And then Caterpillar, those shares, they're higher, a record high, in fact, today, after reporting a bigger than expected profit and resilient demand for its machines. And later this week, we're going to get the employment figures. That's Friday, and then earnings from the giants Apple and Amazon. That comes after the close of regular trading on Thursday. Well, stocks could be getting expensive, particularly the tech stocks, but Patrick Armstrong, the chief investment strategist at Plurimi Wealth, says that's not a reason to sell.
Probably the biggest mistake I made over the last decade was selling these kind of stocks when they had 30 times earnings in 2018 and 2019. They moved much higher after the sell-off then. So you can see a lot of scenarios where they stay at elevated multiples. These are companies with dominant market shares, producing above average growth.
Right now, the S&P 500, 15 points lower. That is down 0.3%. We're at 45.73 on the index. The Dow Jones Industrial Average right now is down 15 points at 35,542, and the NASDAQ 100 down 35 points. Now we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
Thank you, JT. We appreciate it. Jess Minton and Paul Sweeney here in the Bloomberg Interactive Brokers Studio. And we're going to switch things up and do our C-suite conversation. I'm taking a look at what's happening with First Watch. This is ticker symbol, Paul, FWRG. If you're looking at this stock, up about 2% today after the earnings for the latest quarter. The profit and sales did beat, but they also did see some higher expenses there. But looking at this stock year to date, up more than 40%. So who better to chat with us about when it comes to this latest earnings report for the company, as well as the outlook for the restaurant industry, than Chris Tomaso, CEO at this breakfast and restaurant lunch chain here for First Watch. Chris, thank you so much for joining us on Zoom to chat with Paul and myself. I'll start off with talk to us and walk us through this latest earnings report and what you're seeing as far as when it comes to the consumer and spending, what it means for the economy.
Yeah, we had a great quarter overall. Top line performance was great. We were able to take a lot to the bottom line thanks to some relief from commodity inflation that we'd seen in previous quarters. Our consumer's been extremely resilient. The restaurant industry's been challenged lately, but we haven't seen that. We've seen tremendous visitation and the consumer opting for the full experience when they come in our restaurants. They're ordering the beverages, they're ordering the add-ons. So, like I said, a great quarter by our team, top to bottom.
All right, talk to us about kind of where you guys are in your development here. How many restaurants you have owned versus franchisees, and kind of what's the growth plan?
Yeah, we have just over 430 restaurants in 29 states. We're predominantly company-owned. We're about 90% company-owned. 80% company-owned. But we also announced with this earnings that we've acquired some franchise groups and converted those to company-owned restaurants. So that's part of our overall value creation strategy as well.
Where exactly, if you're looking more the demographics through the U.S., where are you based, in what states?
So we're in 29 states, but we're all the way from Florida up the East Coast to New Jersey, over to Illinois, Chicago, Milwaukee, and all the way out west to Denver, Colorado. But our big markets are Texas, Colorado, Arizona, and Florida. But we have a big presence in the Midwest as well.
So talk to us about, I guess, one of the issues, just kind of inflation. How do you see it in your business model? To what degree have you been able to pass it on to consumers? How have you guys dealt with that?
Yeah, this past quarter, thankfully, we saw a lot of relief. We were in a unique situation last year where we, because we're a breakfast and brunch restaurant, we obviously are heavily reliant on eggs, and avian flu was a big issue for us last year. So we saw outsized commodity inflation last year, and we're starting to see that temper. I will say that we were, I would call us a laggard as it related to price increases compared to others in our industry. And in fact, in 2021, we didn't take any pricing at all. And our focus there really was on getting the consumer back in our restaurants, getting them back into a normal cadence of visiting us. And we didn't want price to be a factor that kept them from doing that. So as we got out of COVID as a concept, we wanted to make sure that we came back strong. And so we've been very conservative in our pricing, and we think that's what's led to our traffic increases, over the past couple of years.
What are you seeing with labor costs and wages?
Labor costs continue to increase. We plan for that. We know what our labor inflation is expected to be. Most of it comes from statutory minimum wage increases, specifically in 3 of those markets that I just mentioned to you that are big for us, which is Arizona, Colorado, and Florida. So we know what those increases are, those planned increases, and we know when they're going to hit. So we're able to plan appropriately.
On the competitive front, what is who is some of your main competition? Is it like a Starbucks who's trying to brand, who started with coffee, now offers so much more? Who are really your competitors?
One of the most exciting things about our category, frankly, is that most of the meal occasions at breakfast are still eaten at home. So that's our main competition. But if you think about it, anybody who's attracting a consumer in the morning hours is a competitor to ours. We really feel like we're differentiated. We have the speed and convenience of a quick serve or a fast casual, but in a full service environment, using high quality ingredients. So we offer a different occasion and a different opportunity for the consumer, and we think that's what's helped differentiate us for the 40 years that we've been around.
How do you view the direction of the economy whenever customers are coming in and spending?
So a typical bellwether for, fears of a consumer pullback, typically in the restaurant industry, come from things like managing their check. So maybe not ordering a beverage and having water and things like that. We've seen our dining room traffic actually increase over the last quarter. And also, we're not seeing any check management whatsoever in the dining rooms. Where we've seen some pressure has been in the third-party off-premise channel, which exploded during COVID and post-COVID. In fact, we went from an off-prem business that was about 5% of our overall sales to, at one point upwards of 20%. And it's settled down now around 18%. But you are starting to see, not just with us, but in the industry in general, that third-party delivery occasion, which is the most expensive way to use a restaurant, starting to soften, and we're seeing that as well.
So your company went public September 30th, 2021 by our data here. Talk to us about, or just discuss, what was the IPO discussion for you guys? How did you decide upon an IPO, and why did you do it then, and kind of what was the rationale for going public?
Yeah, so we've been the fastest growing full service restaurant company in America for the last 3 years, and I expect we'll get that title again this year with the growth that we have teed up. We also have 40 years of experience. So we had been with 3 private equity partners and had just determined that it was the right time for us to go public as a way to capitalize the business. And we had to wait for the right time with the market to be ready to accept a restaurant company IPO. And we feel like we kind of opened the door back to restaurant IPOs, which you've seen a number since then.
Hey, Chris, just about 30 seconds left, but my restaurant analyst here at Bloomberg just emailed in and said, the one shift model is great for labor retention. Employees work normal hours and love it. Talk to us about that real quick.
Well, your analyst is smart, because it's definitely a key differentiator for us. Our folks work 1 shift a day. Our hours are only 7 a.m. to 2:30 p.m. They get to be home with their families at night, make a great living, and still have a work-life balance and a quality of life that's really unrivaled in our industry.
Oh, interesting. All right, Chris, thanks for joining us. Really appreciate you taking the time. Chris Tomaso, CEO of First Watch Restaurant Company. I was not aware of it. Now there's another one I've got to go to, and there are some in New Jersey.
There are. I looked it up.
So I did Sweet Green
yesterday.
And I'll do First Watch this weekend.
And then at some point, Cava.
Cava, got to do Cava.
That's another on the list.
All right, First Watch, FWRG is the ticker. Stock's at a 52-week high. They just reported some good numbers, so everything's good there at First Watch, based down in Florida.
Stock up over 40% year to date.
Yep, not too bad. Happy shareholders. S&P 500, we're off about 0.4% here. Same for the NASDAQ. The Dow off basically flat on the day. We'll have more coming up. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, ExxonMobil is reportedly working to build a business around lithium, which is critical for EV batteries. More on that from Bloomberg's Gina Cervetti.
Sources tell Bloomberg that the company is in talks with Tesla, Ford, Volkswagen, and others about supplying them with lithium. Researcher Benchmark Mineral Intelligence says the world will need almost 60 new lithium mines and plants to keep up with demand for the shift away from fossil fuels.
Thanks, Gina. Shares of ExxonMobil currently down more than 1.5%. There's been no shortage of changes to the company formerly known as Twitter since Elon Musk took over. And in another change at X, the company removed a new sign from its headquarters. Bloomberg's Erica Herskowitz reports.
Steve, workers took down a flashing X sign from the top of the building after residents complained about the sign's bright lights and its stability. San Francisco's Department of Building Inspection said it received 24 complaints over the weekend about the sign that was installed Friday without a permit. Representatives for X told the agency the sign was temporary for an event. Last week, Elon Musk's company removed the old Twitter sign with the iconic bluebird from the building. That work was temporarily paused because of permit issues.
Thanks,
Steve?
Erica. And Caterpillar shook off concerns about an economic slowdown, posting profit that exceeded Wall Street expectations thanks to demand for the company's iconic yellow machinery. Irving, Texas-based Caterpillar is one of the world's biggest producers of heavy machinery. Shares of that company now up more than 7.5%. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up after this.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, just met Paul Sweeney here in the Bloomberg Interactive Broker Studio. Looking at these markets here, not a lot of movement here. The S&P is off about 0.3%, as is NASDAQ. Dow Jones Industrial is pretty much even, sitting right here, 35,569. Yields a little bit higher here. We got the 10-year Treasury up 8 basis points, 4.04%. So back up again above 4% on your 10-year. Gold a little bit lower here, $1,945 an ounce. And WTI crude finally taking a little bit of a breather here, off about 0.75%, $81.19. Right now, let's head down to Washington, D.C. Nathan Hager, I believe. No?
Amy Morris.
Amy Morris, World and National News. Thank you for the
It's Amy
save.
this time. Thanks, Paul. A new poll shows President Biden and former President Trump tied in 2024 general election rematch. The New York Times Siena College poll shows both candidates receiving 43% of support from registered voters if the election were held today. Both candidates, however, continue to have high disapproval numbers. The federal grand jury hearing evidence on Donald Trump's efforts to overturn the 2020 election could soon return an indictment against the former president. They're meeting in Washington, D.C. today, after Trump this week predicted charges could come any day now. Former South Carolina governor and UN ambassador Nikki Haley is about to launch her first major campaign advertising push.
Nikki Haley, tough as nails, smart as a whip, unafraid to speak the truth.
A super PAC supporting Haley's presidential campaign tells the New York Times it's reserved more than $13 million in television and digital ads in Iowa and New Hampshire, starting now in August, lasting for 9 weeks. Her poll numbers are in the single digits. An incredible story of a rescue right off the coast of Long Island. Bloomberg's Michael Barr with that story.
Dan Ho went for a swim early yesterday at Cedar Beach in Babylon, but he got pulled out by the current. After treading water for 5 hours with no flotation device, he found a broken fishing pole and tied it to his shirt, hoping a passing boat would spot him. Along comes Captain Jim Hohorst and his friend Michael Ross. They had just headed out on their fishing boat and spotted Ho more than 2.5 miles from where he had entered the water.
He was blue, lips blue, body's gray. He was shaking. He was totally hypothermic.
There were no other boats for miles. In New York, Michael Barr, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg, Paul and Jess.
Thank you, Amy. We appreciate it, Jess Minton. And Paul Sweeney here in the Bloomberg Interactive Brokers Studio. And Paul, as you know, when I'm not here with you doing my day job, I had the opportunity to do today's Taking Stock column for our U.S. equities team. So I was taking a look at what's going on in the ETF space. So this is some data over at Strategas Securities. So looking at more than $340 billion going in the 2,200 ETFs that track U.S. listed equity funds over the past year, investors plowing that much into it. And to put that into perspective, because we've talked so much about this rally this year, obviously different when you're looking at the stock market versus what flows are telling us. But the peak, when you're looking at sort of the frenzy and the euphoria back in 2021, that was actually $700 billion that flowed into those U.S. listed equity funds over that span. So Todd Sohn over at Strategas was arguing that obviously we're seeing that optimism continue to trickle in here, but it's just not at that excessive pace just yet.
And then you also bring up
Bloomberg Intelligence.
Yes, but you also bring up meme stocks. Is that still a thing? Because meme stocks, I guess for a lot of observers, is just an example of over-exuberance, to use this phrase.
So Christopher Kane, who's an equity strategist at Bloomberg Intelligence, who you know, Paul, was looking at this factor that BI has as far as the long-only strategy that buys about 20% of stocks in the Russell 1000 with the highest attention that beat or the low-attention counterparts right now really took off in June. It was flat in July, but typically he was looking at, obviously we haven't seen the frenzy there, but historically, when you look at that, does bode well for the broader market because it tells you basically investors are beginning to take on more risk, but it's definitely not what we would have seen, obviously, during the height of, say, the stimulus checks and everything going on during COVID.
All right, another outstanding Bloomberg News article by one Jessica Minton. She's not just radio and TV, she also is a journalist at heart. We're going to have more coming up. This is Bloomberg Markets.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up, a busy hour coming up. Kathy Seifert, director at CFRA Research. She's going to join us to give her earnings preview for Prudential and what it means for the broader insurance industry. Our C-suite conversation today is Jim Taylor. He's the CEO at Brixmor. He's going to join us to discuss his company's earnings and his industry outlook. That'll be in studio. Then we're going to track down Mandeep Singh, Bloomberg Intelligence senior tech analyst. We're going to break down Uber earnings, what Mr. Khosrowshahi, the CEO of Uber, is saying about the future of the company, and also maybe get a little compare and contrast versus Lyft, because that's what I do. I just open both apps and I compare and contrast.
That's what I do too.
And take the cheapest price. I thought everybody did that, but apparently not. Charlie Pellet, he's going to lead us off here with a Bloomberg Business Flash.
What's going on right now? We have got Uber shares down 5.7%. Rival Lyft, both based in San Francisco, down now by 5.4%. Stocks are trading mixed. Choppy session today with the Dow higher now by 10 points, has been fluctuating between gains and losses. S&P 500 index holding close to a 16-month high. It is lower now by 15 points, down 0.3%. The Dow virtually flat on the day. Nasdaq down 60, a drop now of 0.4%. Russell 2000 slumping by 0.9%. 10-year yield 4.04%, and the 2-year 4.89%. Spot gold down $21 the ounce to $19.44, a decline there of 1.1%, while West Texas Intermediate crude down 0.7%, $81.21 a barrel. J.P. Morgan Chase's trading desk says while stocks may pull back in coming weeks amid concern over Federal Reserve policy, the S&P 500 will reassert itself around September before climbing to a record. Right now, the S&P 500 index is 5% away from that record. Again, the 2-year yield at 4.89%. Nimrit Kang is Chief Investment Officer at North Star Asset Management. She was a guest right here on Bloomberg Markets.
Fixed income is a very viable alternative for our clients now, much more viable than it has been for years. So with a higher yield, so that's definitely close to our strategic weight on the fixed income there.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. JetBlue Airways shares sinking after slashing its full-year profit forecast. That stock now down by 8.6%. Cruise operators are lower as Norwegian Cruise Line Holdings gave an earnings guidance that trailed the average analyst estimate. Norwegian right now down by 13.6%. Rivals Royal Caribbean down 1.8%. And Carnival Corp down 5.1%. Recapping, stocks are mixed. The Dow higher, little change there. We've got the S&P down 0.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much. We appreciate that. Jess Metton, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio, and also live streaming on YouTube. You can just head over to YouTube and search Bloomberg Global News, and you'll get the feed there. That's easy as that. Let's get a sense of what's happening in the individual stocks out there in the market. Another busy earnings day. Let's check in with Alexandra Semenova. She covers all the equity markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at today?
Hey guys, always great to be on with you. I was just about to say happy Wednesday, but it is only Tuesday.
It feels like a Wednesday.
The earnings season always makes the days and weeks feel very long. And one name that I'm looking at today is JetBlue. Shares were down about 8%, dragging down other U.S. airlines as well. Earlier in the day, the stock was down as much as 10%, which marked the biggest intraday drop since June 2022. This comes, of course, after JetBlue slashed its its full-year profit forecast over signs of a slowdown in domestic travel demand, becoming the latest airline carrier to warn about the shift towards international travel and raising a lot of concerns among analysts about how sustainable the demand for international travel is as they assess this post-pandemic recovery among travel-related stocks. The company also said Tuesday that it would earn less this quarter than analysts expected, echoing comments that we heard last week from Alaska Air Group, which also depends on domestic travel. Analysts at TD Cowen said that guidance was extremely disappointing. They said the current revenue environment where domestic fares are trending lower is driving the big reduction in earnings expectations. So we're going to have to keep watching this, post-pandemic recovery in travel. Is it really sustainable to keep relying on these international trips as consumers kind of get, the travel out of their system? How long can this hold up?
Yeah, and especially because Paul and I were chatting with Bailey Lipschultz on our equities team earlier about how Delta, when you put that in comparison, and the record profits that they posted, but a lot of that also was driven more by international travel too. So keeping a close eye on some of the domestic type revenue from a lot of these airline companies. But I'm glad Alex is here because something we've talked so much about is when it comes to strategists on Wall Street and some of the early signs of capitulation that we've begun to see. We already talked so much as she was covering Marko Kolanovic over at JP Morgan yesterday, changing his tone a little bit, but then also, of course, Mike Wilson over at Morgan Stanley, but then overnight hearing from Oppenheimer, them lifting their target, as well as Citigroup. So kind of break it down to us what you're seeing here and kind of what your sources are telling you what this kind of means as far as translating into stock moves here.
Yeah, well, I have to quote John Authors, Bloomberg opinion columnist, who called this a strategist short squeeze, which could not be a more fitting term based on what we're seeing. We got to start with Mike Wilson, one of the staunchest bears on Wall Street yesterday, really softening his tone on this equities rally. He's someone who has a 3,900 S&P 500 target, but yesterday came out and said that this rally resembles what we saw in 2019 when the index returned 29% to investors after a down year. He says that's when we saw stocks trade on multiples and not earnings, which is similar to what is happening right now.
And that was such a different year, Paul, because of what had happened with the sell-off in 2018 versus what happened with the Fed by the time they started cutting rates in the summer of 2019. Exactly. So it was a very different dynamic with the Fed.
Yeah, certainly a different dynamic, but he still says that that analogy implies more upside for the S&P 500 index, which is, such a remarkable change in tone for him as he's been issuing warnings about an earnings recession, saying that stocks have another leg lower. Could he, be the next to change his target? We heard him apologize last week. Not apologize. He said we were wrong, although he probably owes some clients an apology after missing out on this rally. But he said we were wrong. We were pessimistic for far too long. We also heard from Scott Cronert at Citigroup. That was one of the most interesting changes for me because just a month ago he said, as enticing as it is to follow the tape and change our target, we don't see a fundamental reason just yet. Now here we are a month later and he is moving his target to 4,600 from 4,000 previously and his mid-year 2024 target to 5,000. He now sees soft landing optimism and earnings growth recovery in 2024 driving the market higher. So in just the short span of time, there's been such a remarkable turnaround in his outlook.
I just think you kind of get to mid-year.
We just had all of those notes at the end of June, early July with a lot of these firms, and now you're starting them to quickly. I think you even pointed out Citi's change in just a matter of weeks.
Yeah, exactly.
The pressure that builds on these strategists from the firms, particularly from their salespeople, not just the clients, the salespeople, the internal people. Because if you want to be bullish on the market, and if you're not, the internal pressure on these folks is really dramatic. So maybe we're seeing some of that in terms of capitulation. Alex, thanks so much for joining us here. Alexander Semenova, equities reporter for Bloomberg News, joining us here with the markets. Again, kind of a mixed day today, but a very, very strong year-to-date performance, of course. Kathy Seifert joins us right now. She's a director at CFRA Research. Let's talk to us about earnings because we want to talk to Kathy about some of these insurance companies coming up. Let's kick it off, Kathy, with Prudential. Talk to us about Prudential and kind of what's going on there and what some of the recent results have been telling us.
Sure. Tonight is actually a big earnings night for a lot of the insurance names. We're going to be hearing from Prudential and in the next couple of days, AIG, Lincoln National, MetLife. And, the life companies have had a real mixed kind of an outlook. The group had started to recover, and then in the wake of Silicon Valley Bank, investors started to look at the likelihood that they have sort of, the risk profile there was not that attractive. They had duration risk. There was still claim cost inflation, and the group is down a little bit for the year. But I think from an investment perspective, this is very much a group where it's important to look from a bottoms-up perspective because the business models, company to company, vary pretty significantly. You mentioned Prudential, and so, Prudential has three large businesses. Their U.S. business, which does their kind of, life and annuity and retirement products, their international business, which is an attractive franchise, and their asset management business. And, on paper, it looks like a great franchise. I have a hold on the stock despite the share's pretty modest valuation. First quarter results at their asset manager were really weak. They had, I think, like $14 billion of outflows. So, I think there's a lot of potential at Prudential. I just think it hasn't necessarily come to fruition.
And also looking at its stock, ticker symbol PRU, it's down about 3% year to date. And it's interesting to me because revenues at insurance firms more broadly are supposed to have benefited from an expanding premium base, but then also because of those continued rate hikes when it comes to the Federal Reserve. How do you think that how much longer that can continue when the Fed potentially might be near a peak here when it comes to its terminal rate?
Well, in terms of the premium hikes, a lot of the premium hikes, the benefit from that accrued to the property casualty insurers and primarily the commercial lines, P&C insurers, and Prudential's not a big player there. Honestly, in terms of insurance companies, a zero interest rate environment is difficult to manage through, but so too is the velocity with which the Fed raised rates. So honestly, a stable a stable but sort of low-ish interest rate environment is an attractive environment for an insurance company. The problem we're seeing at Prudential on the insurance side, though, is still a lot of claim cost inflation. That's going to be something we're going to look at across the board as a potential, pressure/pain point.
So give us a sense, just, Kathy, how these stocks have performed and kind of is there a consensus call on what to do with some of these life insurers here? Again, we've got rates that are, I don't know, maybe peaking, but we've got the risk of a recession out there. What's kind of the consensus call or the smart call on the life insurers?
Well, it's interesting. I think the group may be at a bit of an inflection point. If you look at the financial sector, and it's underperformed the broader market, the market performance year to date has been pretty narrow. But if you look at the financial group, some of the large cap banks have started to move. The asset management space, it's fits and starts, but that has started to move. I think you may start to see some upward movement in the life insurance space, partly because the group is pretty oversold. I mean, the valuations there are, very low single-digit multiples. They don't get very high multiples. But again, I think you need to look at, for example, one of the worst performers in the group was one of the best performers last year, and that's MetLife. And MetLife had been a play on sort of a stable labor market and employment picture because a lot of their business is sold through, the payday direct marketing. Prudential is a lot more levered to a recovery in asset values. I think the thing to look at in Prudential is what's going on in their asset management group, because that could be a big leverage point for the stock. And, given that allocations into fixed income have certainly increased, echoing some of the sentiments of your previous guest, I think if we see Prudential's asset management group continuing to have outflows, that could be a big problem for Prudential. I think investors rightly so need to ask them, you know, what's the strategy there?
When you're looking at these insurers, how could, when you're potentially trying to eyeball what's happening with this catastrophe environment and continued inflationary pressures as far as just dampening those particular growth aspects for that particular corner of the market?
I actually have a positive view on the property casualty space because I have pricing power, and a property casualty premium can be rewritten depending upon how claim trends progress. Unlike a life insurance policy where you underwrite it in year one, you have claims that may or may not, you know, jive with what your model said, and, you know, you're kind of stuck. So, you know, that and the fact that insurers have pricing power and that demand for insurance coverage and reinsurance coverage is very strong. The insurers have pricing power. There is claim cost inflation. The bulk of the claim cost inflation tends to be in the personal line space, personal auto, homeowners, obviously property lines of coverage as well. But bottom line, though, the underwriters still have pricing power and the demand trends are still very attractive. So my bias tends to be on the property casualty space and the reinsurance space. I like some of the Canadian-based life insurers like Manulife and Sun Life because they've got just better growth drivers and they just seem to be executing a little better. I do still like MetLife. I'm neutral on Prudential. And again, positive on the multi-line insurers as well. Names like AIG and Hartford, like the PC space, like Chubb, Travelers, and Arch Capital. And I like the reinsurance space, like Everest Re, Ren Re, names like that.
So, Kathy, just real quickly, talk to us about property and casualty. I think of, boy, we're going to hear about the August 1st here, insurance. We have a season here for hurricanes. What's the thinking in your industry about hurricane season this year?
The forecast is for a normal hurricane season, but, you know, as Hurricane Ian proved last year, it just takes one storm.
Right.
Which is, the industry has plenty of capacity. They are under leveraged. They write about less than 80 cents of business for every dollar in capital. So there's not a question of needing to raise capital. I like the commercial line space. They tend to write more liability coverage where you still have pricing strength, but you don't have necessarily the kind of claim issues that you have in the personal line space. So my bias is for the commercial line space versus personal, just because of also some of the challenges in the homeowners market. You know, there's a growing insurance crisis in a number of states.
Yeah.
And that,
right.
So I'm
most notably
I'm
Florida, as we've heard. So, all right, Kathy, we're just going to have to leave it there because of time. Kathy Seifert, Director, CFRA Research, joining us to talk about the insurance business, Prudential, after the close. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Good afternoon, Paul. Shares of Uber are down more than 5%, despite the company hitting some major milestones in the second quarter. More on that from Bloomberg's Ed Ludlow.
I wonder if this is a kind of sell the news moment, right? Because all of the metrics were really strong. You know, record ridership, record driver availability and volume in the quarter, record gross bookings, a surprise operating profit on a GAAP basis, net income coming in at $394 million when the street expected a loss of $49.2 million.
Thanks, Ed. HSBC announced a new buyback program as higher interest rates boosted profit in the second quarter. The London-based lender also said it now expects net interest income for the year to be above $35 billion, up from more than $34 billion. CEO Noel Quinn tells Bloomberg he's pleased with the bank's performance.
I think that those results are a function of good revenue growth across the globe. All of our global businesses had strong revenue growth. All of the product lines within those businesses, strong revenue growth. but also all geographies contributed to that performance.
Quinn, on a media call earlier, stressed HSBC's wealth business continues to gather momentum, particularly in Asia. And it's a rough trading day for JetBlue. Shares are down more than 8% after the airline slashed its full-year forecast because of concerns about a slowdown in domestic travel demand. JetBlue also says it will likely earn less this quarter than analysts had expected. Industry leaders for months have been predicting that the post-pandemic boom would last even through an uncertain economy for U.S. travel. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. The Dow, once again, turning negative. Choppy day for the Dow. The S&P, NASDAQ, they are both in the red as well. S&P, though, holding close to a 16-month high. Right now, the S&P 500 index down 18 points to 4570. That is a drop of 0.4%. The Dow flat on the day, down now by 1 point. We've got NASDAQ lower by 68, a drop there of 0.5%. The stock rally that catapulted the S&P 500 to a 16-month high is losing momentum after a flurry of companies reported disappointing earnings. Traders are also wading through mixed data on job openings. We've got the 10-year yielding 4.03% right now, with the 2-year at 4.89%. Spot gold, $19.43 the ounce, down $21 the ounce, down 1.1%, while West Texas Intermediate crude is down 0.5%, 81.37 a barrel right now on WTI. So again, recapping here, stocks are trading mixed. The Dow virtually flat on the day, up now by 3 points. The S&P lower by 0.4%. NASDAQ down by 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Jess Met and Paul Sweeney here in our Bloomberg Interactive Brokers studio. And, of course, we are live streaming this thing on YouTube. So just head over to YouTube and search Bloomberg Global News, and that'll get you there. In our C-suite discussion today, we're going to talk REITs. We do that with Jim Taylor, CEO of Brixmor. Brixmor is a New York Stock Exchange traded company. BRX is your symbol, about $6.7 billion in market cap. I look at the comp function, COMP on the Bloomberg, and it shows me over the last 5 years, Brixmor has had a compounded annual return of about 10.4%, and that compares very well with the Bloomberg REIT index of about 3.6%. So some good performance there.
The landlord behind retailers TJ Maxx, Kroger, Dollar Tree, Publix,
and
Albertsons.
Also, Jim, thanks for joining us here in our studio.
Thank you for having me.
Also, Bed Bath & Beyond. Now, I'm from New Jersey, so this is a Jersey company. They're gone. How much exposure did you have to Bed Bath & Beyond, and what do you do with that space, and what's the rent upside? Maybe, I don't know.
You know, the rent upside is actually very significant. We're in a period of time where there's a supply-demand balance that's very much in favor of landlords, because there's been basically no new supply built over the last 10 to 15 years. So when we have tenant disruption, which you always have in this industry, we're a retail landlord, we're not a retailer. Those tenants, when you get that space back, oftentimes present a significant opportunity for upside for us. So we bring in better tenants, as I like to say, at better rents. Specialty grocer, value apparel, fitness, health, wellness. These are the kind of uses that when you bring into what was a failing retailer, not only do you make a great return, but you help the balance of the shopping center, and you drive occupancy and rate on the small shops as you bring in a more relevant use. So I expect we'll continue to see some disruption. I think the real question, and we've demonstrated it, thank you for highlighting our returns, is how you respond to it. And is it an opportunity to create value for your stakeholders, which we see there it clearly is.
I didn't know this. He's a UVA guy.
Oh, there you go.
Wahoo wah.
All right.
What shifts that have been crucial to your company have you seen over the past year? And what direction do you think this leaves the REIT space moving forward over the next year?
Well, I think open air retail has been stronger for longer than people appreciate. I think it got caught up in the bricks and mortar retail is dead narrative for the last several years. Which we weren't seeing. You know, our grocers were doing well, as you know, through the pandemic. They not only saw a bump, but after the pandemic, they've retained it. It's also a very profitable channel for retailers wishing to connect with the customer. So as we move forward, you know, what's exciting for us is that we're seeing the funnel of potential uses to come in a shopping center as broad as it's ever been. So not only traditional uses like grocery and health and wellness, but mall native retailers looking to come out of the mall, looking for lower cost of occupancy, looking for more immediacy with the customer. So as I look forward, I'm pretty bullish on the ability to continue to drive growth and returns, given that basic, you know, supply-demand picture.
What's a typical property for you guys? Like, what do you like to target?
So about 75% or so of our properties are actually grocery anchored. What we like are larger open air centers, typically over 150,000 square feet, where you have a mix of anchors, junior anchors, and small shops. And the reason that mix is important is you see demand fluctuating in those categories over time. Also, with small shops, you're able to bring in vibrant small businesses and achieve better returns because you're able to grow rents and you see a little bit more turn than you see in the larger anchors. So that's why some of this anchor disruption is actually an exciting opportunity for us, because it allows us to recapture that anchor space and put in a more relevant use.
It's interesting, too, that you're working also in the REIT space when it comes to these grocers like Albertsons that obviously has struggled a lot with rising costs, especially in recent years. What are you seeing in that space when you look at that particular company versus, say, Publix and then Kroger?
You know, it's always been an intensely competitive space with very tight margins, and you're seeing a lot of innovation nonetheless. So you see the mainline grocers like Kroger and Albertsons and Publix doing well, capturing a lot of that pandemic bump and keeping it. But you're also seeing specialty grocers that offer a different value proposition. Sometimes it's more organic or a higher end. Sometimes it's just more value for the money. So you're seeing folks like Sprouts, Whole Foods continue to grow, Aldi and others. In addition to, you do have food being offered by some of the dollar stores as well. So an intensely competitive space and one that, you know, we've capitalized very well on.
All right, if this next question sounds smart, it's because it came from Lindsay Dutch. She's a Bloomberg Intelligence REIT analyst who covers your company. And she writes in and says, you came into the company in 2016. You transformed the portfolio by updating centers, buying better ones, and selling old ones. So the question is, how much is left to go in that transformation, and how has the shutdown in the transaction market impact your plans to continue updating the portfolio?
Well, a great question, Lindsay. So we have about $400 million of reinvestment underway today that's going to deliver at very accretive yields. And as we've told the market, we have about another $1 billion of reinvestment opportunity behind that. Importantly, Paul, that's in what we own and control. We're starting to see the transaction market move our way in terms of valuations of assets that we might look to acquire. Not anything yet, but I'm certainly optimistic that with the credit markets constrained, with asset level financing not as available as it once was, we may have an opportunity to continue to consolidate in a space that's actually owned about 90% in private hands. So the public companies collectively only own about 10% of the shopping centers. So I'm hopeful and optimistic that we'll see some exciting external growth, but importantly, we have a lot in what we own and control today.
Are there any red flags that are bubbling up at this point?
Well, I think you're seeing ongoing tenant disruption, but that's an ongoing part of our business. And as I alluded to earlier, we're a retail landlord, not a retailer. And it's important to appreciate that because we can see the retailer disruption coming for some time, and it gives us a chance to reposition and put the company in a position to benefit from that disruption. But really, the supply-demand fundamentals are so healthy for retail landlords today. I don't think that's as fully understood as it should be. I think people sort of cast retail real estate with a broad brush and sort of fail to see that there's been no new supply for the last 10 to 15 years.
Capital markets, talk to us about what it's like for your type of business.
The capital markets remain open for us. We have access to the unsecured market. Don't like where our equity's priced today, so not really thinking about that. But importantly, and it's a great point, we have access to capital and we have liquidity. We have over $1.3 billion of undrawn capacity. We continue to reduce our leverage. We continue to harvest non-core assets and have continued to park dry powder on the balance sheet.
Do you expect leasing activity to continue increasing?
It has and it will. We have a forward leasing pipeline that's as robust as it's ever been. We also have an additional $57 million of signed but not commenced rent. So these are commitments from retailers to open stores within our portfolio. That rent is coming onto our income statement over the next several quarters. So it gives us tremendous visibility on near-term growth. And then behind that, as I mentioned, we have a very robust shadow pipeline.
Hey, Jim, about 30 seconds left. Just give us a sense of kind of what your geographical footprint looks like and maybe where the areas are for growth.
We're a national company. Okay. We have large presence in the Northeast, down the coast into Florida. We also are significant in Texas, Southern California, and the upper Midwest. Our investment strategy has been to cluster our investments in markets where we already are. So if you look at our acquisitions that we have made, they're in markets like Florida, Southern California, Texas, where we see opportunities for growth. But we've also seen pretty robust demand characteristics in the upper Midwest as well. So expect us to not go into new markets, but to focus on those where we already have a presence.
All right. Good overview. Appreciate it. Jim Taylor, CEO of Brixmor, New York Stock Exchange listed stock. BRX is the ticker to load into your Bloomberg terminal and learn about the
retail landlord,
retail
not a retailer, but looking at how, especially when you are when it comes to Kroger, Albertsons, all these companies that it works with, it's really interesting to see how that space and the outlook is moving forward.
This is some pretty good anchors to have in the marketplace. Right now, let's head down to Washington, D.C. We're going to get world and national news, and we're going to do that with Nancy Lyons.
Thanks, Paul. The federal grand jury hearing evidence on Donald Trump's efforts to overturn the 2020 election is meeting today and could soon return an indictment against the former president. Trump this week predicted that charges could come any day now. Florida Governor Ron DeSantis is out with a 10-point economic plan that he plans to carry out if elected president. And Bloomberg's Anne-Marie Hordern says it places blue-collar voters front and center and also touches on some familiar Republican topics.
This is also about a shift away from the woke policies we've been hearing from the current governor and more about economic plan overall. Tackling China, what do you say about taxes? It's very much so Republican talking points with a bit of populism as well.
Bloomberg's Anne-Marie Hordern says the DeSantis speech is part of an effort to recalibrate his campaign.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
All right, Nancy, thank you so much. We appreciate it. In just moments, we're going to be hearing from Uber CEO Dara Khosrowshahi. You can join Emily Chang and Ed Ludlow out in San Francisco. Uber reported some numbers last night, better than expected. The stock off about 5.5%, giving up a little bit of the gains that it had earlier in the year. But it's a fascinating development there of the story. So let's send it right now to Uber CEO Dara Khosrowshahi, joining Emily Chang and Ed Ludlow, Bloomberg Television from San Francisco. Let's listen in right now.
Our Bloomberg radio and television audiences worldwide. Joining us now, the CEO of Uber, Dara Khosrowshahi, and Bloomberg's Emily Chang with me on set in San Francisco. Emily?
Thank you, and Dara, thank you so much for joining us. It's good to have you back. Look, I think investors are reacting to a bit of a revenue miss, but your first GAAP profit reported ever. Talk to us a little bit about the discipline here and what kind of choices you had to make this happen in this macro environment.
Yeah, absolutely. We're very excited about this. It's a seminal moment for Uber to deliver GAAP operating profit, free cash flow of over $1 billion just in the quarter, along with a really strong top line. You look at our gross bookings growth, it was $33.6 billion, up 18% on a constant currency basis. So I think the results, both in terms of the top line and the bottom line, have been second to none and certainly leading in our industry. And it has taken a lot of cost discipline in terms of really looking at making that perfect match between a rider and a driver, or an eater and a courier and a restaurant, and making sure everything in that transaction happens perfectly, no errors, no mistakes, no cancellations, etc. And at the same time, it takes a lot of cost discipline in terms of overheads. Our headcount has been flat, and if you look at our headcount compared to 2019, pre-pandemic, our total headcount is up 10% during those years, and our gross bookings in the core business has been up 80% versus headcount growth of 10%. So it absolutely has taken that discipline, but at the same time, the company continues to innovate and gain category position, which is what it's all about.
Now, you formally announced that CFO Nelson Chai will be leaving the company, which Bloomberg reported a few weeks ago. What is the interim plan, and what are you looking for? Will this be an internal hire, an external hire?
Yeah, so Nelson is going to be staying with us really through the balance of the year, up until early January, to make sure that we have a smooth succession plan. The next CFO is in seat and can be coached by Nelson as well. And really what I'm looking for is another partner like Nelson. You know, Nelson came in at a very difficult time and teamed up with myself and the rest of the team, taking us through an environment of deep operating losses, taking us through the IPO, getting us a really strong balance sheet so that we could come out of the IPO and could deal with issues like the pandemic to where we are now, which is a leading company. The next 5 years of our journey are about scaling and becoming that true global platform that can grow top line in a 20% range, can continue to innovate, and continue to drive the kinds of margins and the incremental margin growth that we've been driving historically. We told investors that incremental margins as a percentage of gross bookings growth will be 7+%, and consistently we've come in above that because we've been innovating, but at the same time been disciplined at the bottom line. I'm looking for a partner who can deliver kind of the next chapter of our growth, just like Nelson did, Uber 2.0, so to speak.
So let's talk about the executive suite, the broader executive suite in that next chapter. Your CTO left back in 2021, was not replaced. How are you thinking about that role? Is there anyone particular in mind?
We actually, our tech team is led by 3 different leaders. Sanjeev Jain, who's our chief product officer, really thinking about the rider app, driver app, eater app, etc. Gus Foldner, who's thinking about the core services, customer service, safety, insurance, etc. And then Albert Greenberg, who runs the infrastructure. You know, we are at a core a technology company, and instead of having one tech leader, we have 3 tech leaders and that team has come together to drive outsized innovation. When you look at driver upfront fares, when you look at our Uber Teens product, when you look at taxi, hailables, low cost, our entry into new verticals, there's no company in the industry that's innovating at our speed or scale, and it's thanks to the tech leaders that we have in-house at this point.
To our global radio and television audience, you're listening to our conversation with Uber CEO Dara Khosrowshahi following that earnings print. You know, Dara, I look at the quarter gone, number of trips, gross bookings, active drivers, demand and supply side, all at records, strong gross booking forecast. Why wasn't that enough to kind of raise expectations for adjusted EBITDA next year? You'd said in February, I believe, it'd be around $5 billion.
Well, I'm not a stock analyst. I can focus on running the company. And we guided for Q3 adjusted EBITDA well above street estimates. We guided for $975 million to $1.025 billion, which was a substantial increase versus expectations out there. And consistently, if you look at our track record, we've put out targets. We've consistently beaten those targets, by anywhere 5-10+%. And we intend to beat that $5 billion target, just as we've beaten every single target that we put in front of our investors. So we think continued discipline, execution, strong top line growth, increased margins, and more of the same along with innovation is going to get us well beyond the $5 billion.
The innovation piece really interesting. I liked Emily's question about the tech leadership. Em's been all around San Francisco in a cruise. I've been all around San Francisco in a Waymo, and I appreciate for our audience around the world, jumping in a robo-taxi with no driver is not yet a reality. But for lots of people that I asked on Threads, Twitter, LinkedIn, that's their question for you, Dara. When is Uber going to take that fleet of autonomous vehicles as more of a priority?
Well, we are very bullish on autonomous. It's taking time. We have to make sure that the technology is safe. And we're partnering amongst all of the significant verticals that we have. One of the unique aspects of Uber is not only are we global, not only are we the largest platform with the biggest audience, 137 million consumers coming to us every single month, but we operate in every significant vertical for autonomous: passenger vehicles with Uber, delivery, food and grocery delivery with Eats, and then freight as well. Autonomous trucks are absolutely going to be a big part of our future. And if you look at each one of those verticals, we're partnering with leading companies. Waymo, for example, in passenger vehicles, Nuro and Serve, amongst others in delivery. And then in trucking, of course, Aurora, with which we have a strategic investment as well. So we absolutely believe that autonomous is going to be part of the future. And we are working to expose our leading marketplace to autonomous technology as it develops in a safe, efficient manner.
Well, speaking of another kind of technology, artificial intelligence, Instacart's now out with a chatbot, DoorDash as well. Is there an Uber bot in the works?
There's definitely going to be an Uber bot in the works. But I tell you that we have been working with machine learnings, artificial intelligence systems, deep learning systems for years and years and years. Every time you get matched up with a car or get matched up with a courier, there are ML algorithms that are making that match. The pricing that happens, time and day and distance, all of that is driven by machine learning algorithms. So that has been going on, and those algorithms only get better, and the data sets that we work with are the largest data sets globally. And the more data we have, the smarter we get, the more personal we can get. We're now focused more on productivity applications. So, for example, introducing GitHub Copilot for our developers, or helping summarize situations for customer service agents so that they already know context of what's going on with a particular customer and how they can help. We will absolutely put our AI agents out there to help the consumer, but also don't forget about the driver. Drivers who are driving on our marketplace, they also want help. Where should I go? what ride should I accept, et cetera. So we're also working on AI to power drivers and couriers so that they can make smarter decisions every day to be able to earn flexibly, but to maximize their earnings based on their time.
So hang on, just to double down there, is an Uber chatbot something that you're working on right now?
We're working on it right now, absolutely. But it's a very, very small part of the AI ecosystem at Uber.
Our global radio and television audience is listening to Uber CEO Dara Khosrowshahi. Dara, Uber is as close as anything the US and Europe has to an everything app, something akin to what you might see in Southeast Asia. So I'm curious how closely you're paying attention to your crosstown neighbor, Mr. Musk, and what X is doing with an everything app.
It's difficult to take your eyes off of what Musk is doing or read about what Elon is doing. And we do so because we want to learn and listen, it's pretty fun. But we are leading in terms of building out a super app. Remember, too, that in Southeast Asia, we have a very significant strategic investment in Grab. Grab has mobility delivery payments on their app. Kareem, in which we have a big investment in the Middle East, same thing, mobility delivery payments as well. So we're very, very familiar with the super app concept. And in the West, I do think Uber is the closest to achieving that super app. We want to be that operating system for your everyday life. Wherever you're going, whatever you want to get delivered, Uber is going to be there for you. And I think that we are steadily moving along the super app path, which is why we're gaining category position against our competitors, both in mobility and delivery, while delivering margins and being profitable as well.
Curious if freight is part of that super app plan, Dara. I mean, even you pointed out today that, that is the weakness in the business. It does seem to be a drag on the business. What's the plan there? To sell it, to spin it off?
Well, the plan is to build at this point. So freight is absolutely suffering from the same kinds of trends that you see in terms of delivery of things, and retail generally is a bit weaker than spend on services. You saw Yellow, for example, big trucking firm, go out of business yesterday. There's a lot of difficulty in terms of freight, in terms of freight rates, and freight is fighting its way through that. But we continue to innovate. Even today, the way that shippers connect to truckers is incredibly outmoded. There's a lot of paper. There isn't much data. The pricing, the routing, et cetera, is based on technology that was built 20, 25 years ago. As we continue to innovate and as we continue to focus on algorithmic pricing, making that perfect match between a shipper and a trucker, we think over a period of time we can build an asset of great value. So at this point, it's heads down. The team is executing in a tough environment. Our losses are decreasing. We think the second half on a bottom line basis is going to be significantly better than the first half. And next year, we're going to get back to growth.
All right. Our thanks to Bloomberg's Emily Chang in that conversation with Uber CEO Dara Khosrowshahi.
All right. That was Uber CEO Dara Khosrowshahi.
This is breaking news from Bloomberg.
All right, we're going to have more on Uber in a moment, but first, let's go to Bloomberg's Nancy Lyons for Breaking Report.
Paul, we're just learning that New Jersey Lieutenant Governor Sheila Oliver, who made history as the first black woman to serve as Speaker of the State Assembly, has died. She was 71. No cause of death has been given. She'd been serving as acting governor with Governor Phil Murphy on a vacation to Italy, and Murphy's office had announced just yesterday that Oliver had been hospitalized with an undisclosed medical condition. She was twice elected lieutenant governor alongside Murphy, beginning in 2017 and then again in 2021. Oliver was just the second person to hold the post of lieutenant governor, which is a newer state government position that had begun under previous Governor Chris Christie. Again, New Jersey Lieutenant Governor Sheila Oliver is dead at the age of 71. Now back to you, Paul and Jess.
All right, Nancy, thank you so much. We appreciate that. We'll certainly have more on that story as the day goes on. Follow Bloomberg for all the details. Right now, let's get back to Uber. We just heard from Uber CEO Dara Khosrowshahi. Strong report out of Uber just recently, really highlighting the power of that brand. Let's bring in Mandeep Singh. He covers Uber and all those technology companies for Bloomberg Intelligence. So we heard Dara Khosrowshahi on Bloomberg with Ed Ludlow and Emily Chang. Mandeep, seems like they got everything kind of working pretty well.
Well, and that's where when you look, 18 months out, you have to ask yourself, is this the best confluence of factors that, are supporting the top line and they're improving the numbers? And I think that's what investors are focused on here is you've got a really a nice pricing environment. They've been able to raise prices. They have the driver supply advantage because Lyft is not executing. And in the end, can they sustain this momentum? Because we know Lyft is lowering their prices.
Yep.
Delivery is a discretionary business. And I don't think you get that tailwind, or at least, the top line momentum sustaining, given how bad the freight business was, and delivery is a lower margin business.
All right, it's the stocks certainly rebounded, and we're just looking at the market cap, $95 billion for Uber, and $5-6 billion for Lyft. It's just amazing how the paths of those two companies have diverged. Mandeep Singh, technology analyst of Bloomberg Intelligence. Thank you so much for that quick analysis. We'll have more coming up. Let's get some company news right now with Steve Rappaport.
Paul, if you want to keep on trucking, well, you got to keep on charging. Tesla is turning to the U.S. government for help to keep its electric semis moving. Bloomberg's Joan Doniger reports.
Tesla is looking to stake out new ground on the road towards EVs, and it's asking the government for nearly $100 million so it can build 9 electric semi-truck charging stations on a route from the southern border of Texas to Northern California. This would be the first of its kind charging network in the U.S.
Thanks, Joan. It's unclear if Tesla will move forward with the plan if the government grants don't come through. Shares of Tesla down now more than 2%. Caterpillar stock soared to a record after the company reported better than expected earnings and revenue. More from Bloomberg's Abigail Doolittle.
They beat in a big way. Specifically, they put up $5.67 in adjusted profit on $16.5 billion of revenue. Not small numbers. That represents a 5.7% and a 25% beat. That's the degree of strength that they are seeing. So very resilient demand for the company's iconic yellow machinery across all of the business segments. Double-digit revenue growth. Machinery growing by 16%.
Thanks, Abigail. Shares of Caterpillar now trading at more than 8% higher. And CVS plans to cut 5,000 positions from its workforce to help reduce costs as the drugstore chain moves deeper into patient care services. A spokesperson for CVS says job losses will not impact customer-facing positions in stores, pharmacies, clinics, or customer service centers. CVS had more than 300,000 employees at the end of this year. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mint and Paul Sweeney here in the Bloomberg Interactive Brokers studio. Looking at the markets here, got the S&P 500 off 0.3%. The Dow Jones is unchanged, and the Nasdaq off 0.4%. In the yield space, 10-year Treasury still decidedly over 4%, 4.05% here. It's up 9 basis points today, so we take note of that. Gold off a little over 1%, $1,943 an ounce. Right now, let's go down to Washington, D.C. for World and National News with Nancy Lyons.
Thanks, Paul. Some sad news. New Jersey Lieutenant Governor Sheila Oliver has died. That's according to a statement released by the governor's office. She'd been filling in for Governor Phil Murphy while he was on a European vacation. And just yesterday, Murphy's office released a statement saying that Oliver had been hospitalized with an undisclosed medical condition. The 71-year-old Oliver was born and raised in Newark and was the first black woman to serve as Speaker of the State Assembly and the second black woman in the nation's history to lead a state legislative chamber. A new poll shows President Biden and former President Trump basically tied in the 2024 general election rematch. The New York Times Siena College poll shows both candidates receiving 43% of support from registered voters if the election were held today. As Bloomberg's Jody Schneider reports, one constituency, black voters in Georgia, are beginning to appear less than enthusiastic about a second Biden term.
In the Atlanta metro area, which is home to the second largest black population in the U.S., black residents there said inflation and setbacks on policies such as student loan forgiveness have given them some misgivings about the president's campaign.
Bloomberg's Jody Schneider reports President Biden won 88% of Georgia's black vote in 2020, but he won the state overall against former President Trump by less than 1 percentage point. Well, you can chalk up a courtroom victory for Donald Trump in Pennsylvania.
A Pennsylvania state court judge has ruled presidential immunity is broad enough to protect Trump's false claims that the 2020 election was rigged, even when he himself did not believe the conspiracy. Judge Michael Erdos granted Trump immunity on 2 claims made in a 2021 lawsuit by voting machine supervisor James Savage. Savage claimed Trump damaged his reputation by falsely claiming he tampered with the 2020 election result, resulting in death threats and 2 heart attacks. Amy Morris, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
Thank you, Nancy. We appreciate it. Jess Minton and Paul Sweeney here in the Bloomberg Interactive Brokers studio, and taking a look at this latest story from Lu Wang, one of the star reporters on the cross-asset team. She always has crushing it over there, but how J.P. Morgan's trading desk says a record for the S&P 500, quote, feels inevitable. And looking at just doing the percentage change quickly here for the S&P 500, off about 4.6% from its January 3rd, 2022 closing high, Paul.
Yeah, 47.96 is that high in the stocks. You know, it had a 28% advance, off that low. It's just kind of amazing here. And you think about it, I mean, the J.P. Morgan trading desk, they talk to everybody globally. They know what everybody's thinking, and they kind of feel like the market's just moving higher. Now, that's at odds with the firm's own strategist, Marko Kolanovic.
4,200 is his price target coming into this year and still has kept it there.
Yeah, and it's tough to maintain that position in the face of what has just been a market that's just really moved higher, despite still a Fed that has been and continues to be raising interest rates, but it's defied that. And we're right in the middle of earnings season. We've got 3/4 of earnings declines here, so we've had an earnings challenge.
Yes.
But I think the bulls would just tell you, hey, this market, as it always does, as it's supposed to, looks forward and discounts forward. And I guess the bulls are simply saying, okay, we're at or near peak rates. I don't know when they're going to go down, but they're stopping going up. And I'm probably at an earnings trough too.
Right.
So.
Gina Martin Adams over at Bloomberg Intelligence looking at S&P 500 earnings, excluding energy, masking some of the strength in other industries in the S&P 500. So when you take that out, back to earnings growth for the S&P 500 in the second half of this year, Paul.
Yeah, and so that's kind of what gets the bulls moving higher here. It's funny, Doug Cass from CB's Partners, a noted money manager, he was on with Tom and I earlier this week, and he's bearish. He thinks it's gone a little bit too far, too fast. So in the near term, he's a little bit bearish. See how it plays out. Sound On with Joe Matthew starts from Washington, D.C. right now.
filed, one centered on curve finance and another in the courts. We're going to discuss this with CoinFund's Chris Perkins.
Plus, the Fed's new real-time payment system went live in July. We'll talk about the banking and fintech fallout with Aaron Klein from the Brookings Institution.
And we're going to dig into the latest proposed new crypto rules out of D.C. with Crypto Council for Innovation CEO Sheila Warren.
All right, all of that is ahead. It's going to be a packed show. But first, let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. And what you will find is it is largely a down day for these digital currencies. Bitcoin and Ether leading that. They're each down about 1%. Bitcoin right now trading just under $29,000. Ether's at $1832. And then XRP, we have to note as well, of course, that has been the token in focus over the last several weeks after that ruling from a judge that found it is not a security when sold to retail investors, only to institutional investors. A new case, though, and the judge in that one not making that same distinction when it comes to Terra. Sonali will have more on that in just a minute. But that idea that there still is a lot of uncertainty around what is and is not a security, and ultimately questions about what that means for some of the other cases the SEC has brought against players like Coinbase are dragging on sentiment today. Coinbase, that exchange, down about 5.4% at this point in the session, Sonali.
Speaking of that uncertainty around crypto regulation mounting, a New York judge rejected a ruling made earlier this month that a Ripple token was not a security when sold to the public. District Judge Jed Rakoff allowed the SEC to move forward with its case against Terraform Labs and said, quote, "The court declines to draw a distinction between these coins based on their manner of sale, such that coins sold directly to institutional investors are considered securities and those sold through a secondary market transactions to retail investors are not." Joining us now to discuss this is Chris Perkins, CoinFund president. When you look at this Terraform case, what does it mean not only for Ripple, but also more securities that other exchanges, say Coinbase, are privy to?
It's confusing, right? It's very confusing for our founders. And gosh, you're going to continue to expect outputs like this if we look at the past. You know, the Howey test was created decades ago. And when we're looking at this new technology, wouldn't it be better if we were to focus on nuanced, proactive regulation that really understands the technology and actually tries to cultivate it? I was on the phone with senior government officials from the UK last week. I met with them. I met with Japanese officials. And they're like pounding their fist on the table saying, come to my country, bring your founders, let's build. So rather than look backwards, I'd rather look forwards.
How do you put money to work with that kind of uncertainty on what is a security and what isn't?
Well, the good news is that we're on a roadmap to clarity. We're going to get it one way or the other. We're very hopeful that, you know, the four bills that were advanced, the first time ever we've had crypto-specific bills that advanced out of committee. That's the ideal way forward. In the interim, we're going to get that clarity one way or another through the courts, and that will allow our founders to build. So, like, again, we're really focused and hopeful that our Congress will get together, our elected officials will give us that, you know, that policy that really cultivates innovation. That's where we should be.
Well, Chris, this is just one of the stories, as we were mentioning, that is maybe working against broader crypto sentiment today, this idea of uncertainty around regulation. Another, though, is Curve and the attack we have seen taking place on it in recent days. What is the broader contagion risk for DeFi?
Yeah, look, Kaylee, I wish I could wave my magic wand and get rid of bad people. That would be great. And I used to be a Marine, and I tried that in a way. So you're not going to let them go away. And we see bad people operating in traditional finance, and we also see it operating in the crypto sphere. I think the important thing here is that in crypto, like in the old days, we could always find the bad guy or bad girl, but we couldn't find the transactions. With crypto, you actually can find the transactions, and in many ways, it allows you to find the bad person or the criminal. So we're very encouraging that, you know, officials, law enforcement, you know, they take robust action against people that hack. And I think the other thing that excites us, frankly, is that we're seeing a number of interesting products. You know, we're in the venture space, and there are some really smart people building second and third generation type of security projects that are going to help make it much more difficult.
Well, let's talk about some of those projects you have invested in, because this is also related to DeFi. WorldCoin, Chris, which we just saw officially launch. Are you happy with how that launch has gone so far? Ultimately, what do you think WorldCoin is going to do and change?
So we're investors in WorldCoin. We've invested since 2020. So this is a team that's well known to us. I was speaking to some of my investors today. They've known team members from 2018. WorldCoin is very exciting. And why is that? It's because we're entering, and it's exciting to work at CoinFund because we're at the absolute frontier, and we see what's happening with AI. We see what's happening with crypto. And even if you look at Web 2, the bots are out of control. And so as we move forward into this environment, it's going to be really important to understand proof of personhood. Who is a human and who is a bot? And WorldCoin is a very interesting solution because for the listeners who don't know, what they attempt to do is use biometrics. And biometrics are a way of proving that someone's a person. There's other ways to do it via social graphing, and perhaps there'll be numerous capabilities that come online to really determine who's a person and who's not. And so particularly when you see the intersection of AI and crypto, proof of personhood is going to be really important. And we're excited about the team. It's a controversial project, but we believe that the team is incredibly focused on privacy and really espouses those Web3 values that we believe in.
But speaking to controversy, some of the issues, the worries behind this is biometric data we're talking about. What if the project were to get hacked and expose biometric data to people that shouldn't have it?
Look, I think we have that same fear with Clear, your iPhone, and everything else. We know that the team here has invested a significant amount of time, energy, and effort into creating what we call this orb. And the technology that we've reviewed ensures that they use zero-knowledge, ZK technology, to ensure that data. Now, you always have risks, right? But we'll continue to work with the team to help them with any resources they need.
At what point, and do you see WorldCoin coming to the United States?
Well, it's already here. I've had my orb personally scanned. It's a matter of when will the token drop. And I think maybe it goes back to, gosh, it sounds like a lot of these cryptocurrencies are a lot like oranges. And so as that narrative plays out, I think you'll see the token become available here. But yeah, it's here. You can get your eyes scanned on the orb. And again, I think it's going to deliver real utility as we go into this brave new world.
Speaking of brave new worlds, the world of financial regulation is, in theory, about to change very soon now that the Basel III endgame has fully been laid out, Chris. And this is something you were actually tweeting or Xing, maybe we call it now, about just recently, how the Basel rules drive bank behavior. You essentially said that smart contracts should benefit from this because it's going to drive more financial activity outside of banks. How does this read through into crypto?
What a lot of people don't understand, and I spent 15 years in traditional finance on Wall Street, yes, banks comply with markets regulation, but if you want to know what really drives bank business behavior, it's the Basel rules. Because as you become a senior banker, you're very focused on returns and optimizing those returns. The great news about Basel is that it was an incredible unlock for crypto. Why? Because they gave us rules, capital rules for cryptocurrencies. I'd never seen that before in my career, that we have a brand new asset class. And frankly, it was one of the drivers that launched my career into crypto full time. Now, that said, the crypto rules right now are very, very punitive for banks. Things like 1,250% risk weighting. I was the guy who got Bitcoin and Ethereum futures approved at Citi. It wasn't easy. And when I did that, it's very obvious that you can't really scale that business because the capital is so intense. And so the good news here is that smart contracts can actually perform many of the traditional functions of banks. You can settle trustless, permissionless. And so, I think that you're going to see, because it's so punitive, the other thing you'll see is probably some additional products that emerge that are synthetic. We have recently launched a product named Caesar, which was an interest rate derived from Ethereum. So there'll be innovation on the synthetic side, but you're going to see probably a lot of activity moving because of Basel into the private side, not too different than private credit.
Chris, thank you so much for your time. That is Chris Perkins of CoinFund. Coming up, Brookings Institution's Aaron Klein on FedNow and crypto's core financial purpose.
Plus, Sheila Warren from the Crypto Council for Innovation will join us with the latest on regulations and the bill advancing through Congress.
And to access all of the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
About your economy and Greece. When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that
in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street week you won't want to miss. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make this decision.
This is Bloomberg.
As we're starting to look at FedNow, this is going to be a brand new payment rail coming in, and we expect it to increase consumer choice, increase competition, increase optionality. Many cryptocurrency companies are likely to use FedNow as a funding mechanism or a funding rail to move money into, for example, a cryptocurrency exchange. So you still have to fund that account. So the reality is I expect these two to interplay well. I expect these two to end up living harmoniously together.
That's the CEO of Plaid on Bloomberg Technology last week, and this is Bloomberg Crypto. I'm Shonali Bassick in New York with Kaylee Lyons in Washington. We're going to talk more about FedNow and its impact on the financial system and crypto at large. Aaron Klein is a senior fellow at the Brookings Institution Center on Regulation and Markets. When you think about the impact that FedNow could have both on the banking system and the crypto industry at large, what is the most significant impact that you see? How does this kind of go along the next couple of years?
Well, look, the real potential of FedNow is significant. America has lacked a real-time payment system that any bank could operate into. We had one in the real-time payments network that the private banks built. It had limited usage in part because the Fed announced they were going to build their own system, so the Fed kind of put a chilling effect. Most of the rest of the world has real-time payments. When people come from Europe, from the UK, from Asia, they're shocked at how slow things take to settle on the back end in America. FedNow is a tool that could make that happen.
So it's interesting. This is really about settlements here and payments, but how do you rope in the conversation around central bank digital currencies as it pertains to FedNow?
Well, so central bank digital currencies, to be a digital currency, we have digital currency. We have commercial bank digital currency, right? The question is, should we swap the first C, commercial bank, for a new C, central bank? A lot of other countries are thinking about this, in part because they're concerned about disintermediation from crypto and other digital currencies that don't have a B in them, bank. I'm skeptical of the case for central bank digital currency, particularly in the United States, but also more so globally. And I think there's been a lot of rumors and falsehoods propagated, primarily online, that FedNow is somehow some linkage and going to start a central bank digital currency. In reality, a central bank digital currency is pretty far away in the United States, if at all.
Okay, so you're skeptical on CBDCs, Aaron, and hello, it's Kaylee from Washington, but I've heard a lot of skepticism on FedNow as well. The idea that you would have to have so many different banks buying into this, that this is actually a much harder feat to accomplish and kind of scale. So how aggressively does the Fed need to ramp this up in order for it to actually work?
So, Kaylee, I share those concerns. I think FedNow has a real danger of being a plop, a bust. Particularly if you look at the original, there's only a handful of banks, I think in the upper 30s that signed up. There are about 20 more providers. I think it could be a bigger boon for things like Plaid and other fintechs that are intermediaries. In order for the Fed to really make FedNow or faster payments a reality in America, they're going to have to use their regulatory authority to give people access to their money faster. Why? Banks make a lot of money sitting on people's money. So it's not necessarily in the bank's best interest to be an early adopter and to give people access to their money faster, particularly when you consider such unique American things like overdraft fees, which are multi-billion-dollar sources of profit in the banking industry.
Okay, so Aaron, is this another way of saying that at least for the time being, unless we see that aggressive ramp up happening and some of these incentives to get banks on board put into place, that this isn't any real danger to crypto in terms of being a payments mechanism?
Yeah, look, I think there's the danger is that FedNow is an overhyped solution that the Fed fails to follow through with and then draws the wrong inference that there isn't demand for faster payments. The rest of the world moved to faster payments years ago, right? England's had this system since the first iPhone came out. As it relates to crypto, it's a little confusing. Crypto has long hyped that they were going to be this real-time payment system. And the reality is blockchain is slow. So FedNow is much faster, and in fact, Visa maintains to be the fastest in the class, far faster than any crypto that I'm aware of.
Beyond technology, you were mentioning the slowness of blockchain, at least when it comes to the traditional financial system. You've brought up this idea that the government doesn't really want to facilitate the creation of a CBDC either. What is that tension between the Department of Justice and the idea that a CBDC could see the light of day?
Yeah, so it's a great point. People think about the government as one entity, but they're really multiple power centers struggling, right? The Federal Reserve, I think, is quite intrigued by the idea of a central bank digital currency. Sometimes I think the Federal Reserve reminds me of the Will Ferrell and that Mount Moore cowbell skit on SNL. Like the Fed sees a problem and the answer is always more Fed, right? But other parts of the federal government aren't as clear. President Biden, in his executive order, said the Department of Justice is the arbiter whether or not existing law allows the Fed to issue a central bank digital currency. Prior to that, the Fed said it was the arbiter of whether the law gave it that authority or not. Rumors in D.C. are the DOJ has been very clear that the Fed lacks existing legal authority. Members of Congress have asked to see a memo required under an executive order produced by DOJ. The White House hasn't shared that memo. So, it's not entirely clear that the government is all on the same page of this. And the Department of Justice is flexing its muscle in other areas in financial regulation. Here at Brookings, we hosted DOJ's Associate General Cantor, who spoke at Brookings and put a little cold water on bank mergers, something that historically the regulators have handled and DOJ has just kind of stamped along. And now he's saying DOJ could flex its authority in that area too.
All right, well, something I'll continue to monitor here in Washington, and we'll look forward to hearing more from you on in the future. Aaron Klein from the Brookings Institution, thank you very much for joining us. Coming up, we have more to go. We'll have part of my recent conversation with the chair of the SEC, Gary Gensler, on what qualifies as a security and the regulatory puzzle. This is Bloomberg Crypto.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The names news that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Crypto. I'm Kaylee Lyons in Washington with Sonali Bosick in New York. Well, the regulatory strife between the crypto industry and the SEC is intensifying with one fundamental question. When is a digital asset a security? I spoke to SEC Chair Gary Gensler about that last week in an exclusive interview.
The securities laws are clear, and if the public is investing in your project because they're anticipating profits based upon the efforts of that project or those entrepreneurs, Congress painted with a broad brush. And I would ask you this, it's like when you look at a token, you can find a website, you can find a CEO, you can find a Twitter or X feed, whatever it's called these days. And there are entrepreneurs behind many of these projects without, again, prejudging any one of them.
Elsewhere in the crypto space, I'd like to discuss the spot ETF because we have seen a wave of filings recently from BlackRock and others trying to finally achieve this. One has never been approved in the U.S., just a futures ETF. It seems like everyone thinks there has been a tone shift, that something is different this time around. What do you make of that wave of recent filings? Has anything actually changed for the SEC?
Well, Kaylee, it probably won't surprise you. Those filings do ultimately come up to a 5-member commission, so I can't prejudge any filing. But back to your colleague, as I said, this is a field that there's a lot of non-compliance in this field, and that the platforms themselves, where trading is occurring of various crypto tokens, though some of it comes under the securities laws, currently they're not necessarily compliant with those time-tested protections against fraud and manipulation.
That was our exclusive interview with SEC Chair Gary Gensler. And joining us now to continue more of this regulatory conversation is Sheila Warren, the CEO of the Crypto Council for Innovation. So, Sheila, I was having that conversation with Chair Gensler after the Ripple case had come down, before the judge ruled yesterday to not make the distinction between institutional and retail investors in the case of Terra. Created even more uncertainty, perhaps, about securities laws and what is and is not. Where do you think we go from here, especially in light of the moves Congress is trying to make?
Well, I think that's exactly the point, Sonali, is that we are seeing Congress really try to get moving forward with this and try to basically take a steer around this. And I want to just contest what Chair Gensler said in your interview, which is it's not the case. It's not the case that there is ultimate clarity on which agency regulates which asset. And that's exactly why Congress has acted. We saw last week historic moves in a bipartisan way out of the House with 2 different bills designed to focus on exactly this topic that are now ready to go to the floor.
It's interesting to watch these bills go to the floor, but at the same time, you're watching this play out in courts. And so which moves first, the courts or Congress?
Well, generally, it's such a great question in the United States. Ordinarily, I would say, Congress is going to move first. But as we've seen here in the United States right now, this has nothing to do with crypto. We're at a time where there's a lot of challenge in getting anything to move through Congress for political reasons. So the courts tend to we're looking at another year, really, for this trial to play out before an appeal could even be filed, in the Ripple case specifically. That's a long time. It's a pretty long time horizon. But we're also looking at moving into an election year. So whether any piece of legislation, especially something as complicated as these pieces of legislation, the FIT bill alone is 200 pages, right? Drafted. Whether any of those things actually move and don't get kind of stuck in the bog down we generally see in an election cycle year when everybody starts to go out and campaign, it remains to be seen. It's really a bit of a coin toss, I'd say, to be honest. But I think the fact that you've got Congress making such big, giant moves in this bipartisan way really indicates that it's not obvious what the frame is here and how digital assets are and should be regulated in the United States.
Sheila, we only have about a minute left, but while there was more bipartisanship perhaps on this market structure legislation, there was a rift between Patrick McHenry and Maxine Waters on the Financial Services Committee when it comes to stable coins. How much cold water has been thrown on the idea of stablecoin legislation advancing?
Well, it's interesting. You just had Aaron on to talk about FedNow and CBDCs, and I do think all of that is somewhat related. And I think you're seeing a little bit of hesitation on the part of some of the Democrats led by the administration in terms of whether we need to move on this right now. The issues remain the same as they ever were. The relationship between the feds and the states. We have a robust network of fed and state regulation in the same spaces in this country. This would not be new. My hope is that that will continue to progress. We think we have the votes in the House to move that forward. But yes, there definitely was a sort of last minute flag on the play there that came down.
And as we know well, the House is one thing, the Senate is another. This is a Washington divided. So we'll continue to hope that you come back to us as this conversation moves forward. Thank you so much for joining us, Sheila Warren of the Crypto Council for Innovation. We appreciate your time. And thank you very much to Sonali Bostic for joining me this week. Matt Miller will be back next week. We'll be catching up with Terrence Yang, Swan Bitcoin Managing Director. Don't miss that next Tuesday at 1 p.m. Eastern Time, right here on Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome to Bloomberg Markets. I'm John Ehrlichman.
And I'm Sonali Basak. Matt Miller is off today. We're going to get a check on the markets because if you take a look, the JOLTS data is not jolting the market. If you take a look, the S&P is down about 0.3%, about 366 stocks here or so in the red on the day. You are also looking at a NASDAQ 100 about 0.2% down on the day. You are also looking both at the 2-year yield as well as the 10-year yield, both up on the day. You are looking at a 2-year at about 490. You are looking at a 10-year, John, at about 404.
And you mentioned that we've got an overall S&P that is a little bit weaker, Sonali, after 5 straight winning months. And sector by sector, generally seeing underperformance. It's been a mixed earnings day, a busy earnings day, and a lot of investors are excited about the CAT story. Caterpillar shares up almost 8% in record territory as it continues to flex profit muscle. But you've got Uber shares, which are off about 7%. Even though they showed operating profit, the revenue story seemed to be a bit of a concern. The CEO speaking with Bloomberg earlier. Let's also take a look at some other earnings stories where you've got Molson Coors, the beer sales story, not satisfying investors. Those shares are off close to 4%. And then there were pretty high expectations, let's face it, for a cruise line operator like Norwegian. Its stock off 13% right now. Stock's had a huge run this year, Sonali, and the profit outlook falling short of some expectations.
They sure are. And our next guest says equity investors should take some cues from the lending markets because he anticipates a rise in defaults and tightening credit. A little bit of trouble on the horizon. We have Richard Byrne, the president of Benefit Street Partners, to talk just about this. Richard, if you take a look at the market, it is feeling some of that negative sentiment today. It is true that we have seen defaults already on the rise. So what are the credit markets where the public credit markets are very sanguine, telling us things that the equity markets are not seeing?
Well, first of all, Sonali, thanks for having me here. Yes, I think a lot of times equity investors should take cues from credit investors because there's so much going on in the market. Like, for example, everybody talks about, the looming recession, soft landing, hard landing. By the way, we think it's going to be a very soft landing. We think rates are going to stay higher for longer, but there's wars, supply chain problems. But I think the real problem already occurred. It's just the dramatic rise in interest rates. And the impact of that is the reverberations, I should say, are just being felt now, and I think are going to continue to be felt.
Those reverberations, talk a little more about what that looks like, the delayed effect of the higher interest rates, because you have some of the market calling all clear, waiting for cuts, let alone more hikes. So how long do companies feel that pressure of higher rates for?
So definitely not all clear. So what happens with higher interest rates is it's great for lenders like us. So we're a lender. We lend to corporates, we lend to real commercial real estate properties, and when you get higher rates, that's great. Our net income just rises because, the loans that we make are generally floating rate, and they rise with the higher rates. But it can only go so far without it kind of breaking or there being a problem. And the problem is with the underlying borrowers, right? Because those underlying borrowers can only withstand so much rate increase before the credits start to deteriorate. I'll just give you a quick stat. The average loan underwritten in our private credit business across the market was about 2.5 times interest coverage. Cash flow covered interest by 2.5 times, pretty self-explanatory. If you just adjust for today's higher SOFR, 5% versus something below 1% back then, that's now like 1.5 times. So a 1.5 times credit is still not defaulting in theory, but boy, has that margin for error declined, and that's why you're going to see higher defaults for the underperforming subset of that group.
Richard, everybody's been trying to figure out what kind of market this is in history, and having gone through so many different credit cycles in your career, does this current environment remind you of any past chapters?
You know, that old saying that, you know, history doesn't necessarily repeat itself, it rhymes. This certainly looks like, and you can sort of take little bits of pieces of things. A lot of people like to compare it to the global financial crisis, but I think this is much more specific. The percentage increase in rates is probably higher than anything we've seen. I don't know, I'm not a historian, but, you know, to go from near zero interest rates to over 5% now on some of these base rates, that's literally an infinity percent increase, is pretty dramatic. And I think, you know, as we talked about reverberations are important, but it's not just the negative that, you know, potentially defaults rise and, you know, there are credit problems across portfolios. There's also the positive side of it, because markets are resilient. They're Darwinian. They correct to attack the problem. And what's happening now is M&A volumes are far lower because, you know, buyers of companies need to adjust to the tightness of credit, the higher costs of credit, but also the way lenders are structuring deals. They're demanding bigger equity checks. For example, a leverage buyout of 2020, 2021 vintage typically had about 40% of the purchase price was the check written by the private equity firm that was buying the company. That, believe it or not, is up to something like 60% now. So people talk about, you know, everything is bad, you know, higher defaults and all this. But to us, this looks like one of the best vintages of new deal flow that we've seen in maybe since the global financial crisis, because deals are being restructured and there's a dearth of demand for the deals as well, so that you're kind of getting the pick of the litter. You're getting higher interest rates, you're getting lower leverage, you're getting better covenants. So there's certainly a very bright side to that story.
And let's look at it specifically through the lens of commercial real estate, which is a market you know extremely well. For those who are deeply concerned about the outlook from here, what would you say?
Well, commercial real estate, I would say, quote Mr. Dickens, is a tale of two cities. First of all, commercial real estate suffers from the exact same problem we identified with corporate lending, in that rates are higher. That was a cataclysmic event, and the market's just adjusting to that now. All those companies are going to have to refinance those floating rate loans. Those companies aren't worth as much as they were before, because higher rates means higher cap rates, which means lower property values, which means when you refinance a loan, all but for the best performing properties, there's probably a missing piece of equity or mezz or something that's going to have to fill the gap, or maybe the borrower will hand in the keys. But I said a tale of two cities because that problem's bad enough. I see the graphic on the screen. Office. Office has become a four-letter word. Maybe they should slice off the C and the E at some point. But in addition to the rate problem, office has, you know, just a secular problem where, you know, work from home and all the well-publicized on your show and others, everybody has talked about, and that's just making it worse. And just to finish that point, we said maybe the theme of today is credit markets, you know, take your cues. Well, one cue is even if for buyers who see value in office, who's going to lend them money to buy the office building, right? If a lender is going to look at an office loan like us, we're going to want equity-type returns because it's equity-type risk. And last I checked, most real estate investors like to use leverage. So that just makes the return expectation even higher if they can't get it.
Richard, speak to investors a little here, because you are also running a REIT that is facing a little pressure in the market today after reporting earnings. So how much worse do things get before they get better, and how are you managing this portfolio to make it through the storm?
Good. Well, we manage a commercial mortgage REIT, symbol FBRT. We lend money to commercial properties. We're in a very fortunate position, Shanali, of our REIT is 77% multifamily borrowers. Unfortunately, there's some peers of ours that are heavily concentrated in the office sector. We only have 6% office. So, you know, navigating this storm, thankfully, has been, you know, a lot easier just given the construct of our portfolio. We also don't have very concentrated positions. Average loan size is, you know, less than 1% of our book. So, you know, thankfully, those waters aren't nearly as choppy, but for all the reasons we said, we're certainly spending a lot of time looking at the portfolio and trying to head off problems long before they arise.
multifamily, at what point do you think that things start to get better in that world as well, given this, we're talking about interest rates as it pertains to the equity markets and companies in default, but what about people who are looking to buy a house or to weather any pressures they're feeling in an elevated inflation cycle?
Well, interestingly, the work from home, just for all the reasons that office is suffering, the residence became even more valuable because, that's now people's place of business, or it's doubling as a home and an office. So we feel really strong about multifamily. Also, remember, multifamily loans also have the loans we make are typically called transitional loans. They, a buyer of a building might, upgrade the property a little bit and as a step before they get their permanent financing. Well, remember, the government, or Freddie Fannie, is a perfect takeout for these types of loans, and that bid has not stopped. So there is a lot of liquidity in multifamily that you're just not seeing across the other product types, certainly not in office.
Pretty fascinating dynamics. That is Richard Byrne, the president of Benefit Street Partners. Thank you so much for your time. Now, coming up next, Overstock is now Bed Bath & Beyond. We're going to discuss today's rebrand with CEO Jonathan Johnson. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and radio.
This is Bloomberg Markets. I'm John Ehrlichman with Shanali Bassick. Time now for our stock of the hour. Overstock has a new online name, rebranding as Bed Bath & Beyond. It's part of a plan to grow its online retail presence. You might recall Overstock acquired the rights to the brand out of bankruptcy. And Shanali, we've already seen Overstock relaunch the Bed Bath brand here in Canada.
Absolutely, and we are joined now by Jonathan Johnson. He is the CEO of Bed Bath & Beyond. Jonathan, when you look at this rebrand that you've taken on for less than $22 million, you bought the IP and other assets from Bed Bath & Beyond. How much more like Bed Bath & Beyond are you going to become?
You know, the legacy Overstock and the legacy Bed Bath & Beyond, the product categories had great overlap. Bed Bath was a little more bed, bath, and kitchen. We were a little bit more the rest of the home. We think bringing it together really creates an ability for our customers to make their dream homes come true. So there'll be a lot of ways that we're the same. The way we'll be primarily different is we won't have physical brick and mortar locations.
And Jonathan, with respect to the names specifically, how should people think about Bed Bath & Beyond and Overstock from here on out?
So we are rebranding to Bed Bath & Beyond. If you go to the site today, you'll see the Overstock logo there so that our legacy customers, know they've come to the right place. But over time, and I think relatively quickly, the name Overstock is something we'll sunset, and we'll just be Bed Bath and a much bigger and better Beyond.
So one of the things Bed Bath & Beyond was really known for was this idea of discounts, that 20% coupon that you got. How are you thinking? And, obviously Overstock has also given great deals. How do you think about discounts moving forward, especially given the troubles that Bed Bath & Beyond had run into some of the time from that?
We'll continue to be very promotional and offer our own coupons, but what I think customers will see is that our pricing is a little bit sharper than Bed Bath & Beyond's has historically been. Now, I will say, as we come out of the gate, there are huge promotions going on today and for part of this relaunch. For example, if people download the new Bed Bath & Beyond mobile app, we're giving a 25% off coupon. So those people that love the Big Blue coupon, they will love our mobile app.
And Jonathan, we referenced that you already rebranded here in Canada. Still early days, but is there anything anecdotal you can tell us about what you've seen so far?
Great launch in the first month or so in Canada. More direct traffic to the site than we've seen in the past. Our return on ad spend for our performance marketing online has been higher. And then when customers are on the site, they're more likely to not just put something in their cart, but click that submit button. So the conversion on the site has been higher. All in all, the experience we've had in Canada, very positive, and made us want to hurry and rebrand and start today's rebrand in the U.S. today.
We were joking in the commercial break about Dyson vacuums. Really, my question comes down to, are there kind of luxury home items or more high-priced home items like the Dysons or other things that can now become available at a promotional price given the two brands put together?
So since this deal has been announced, we've had many name brands come to us and want to sell on this new Bed Bath & Beyond site. Since in the last several weeks, we've added over 600,000 new products, many of them name brand, many of them small appliances, kitchenware, those kind of things. So customers who loved shopping at Bed Bath & Beyond will feel very comfortable, find the same great product at even better prices.
Jonathan, one interesting trend we've seen on Wall Street the last couple of years is nostalgia around certain brands, including Bed Bath & Beyond, which had essentially become this so-called meme stock. As you embark on this journey, do you think a little bit about that investment crowd as well and how they had somewhat perceived the Bed Bath brand these last couple of years?
We're really focused on pleasing the customer. We know when we please the customer, performance will come. We did note before we bought the brand what an outcry there was from customers who were upset it was going away, that those coupons would go away, that maybe their welcome reward points would go away. I should say, as part of our promotional relaunch, we are reinstating much of the welcome reward points that went away in the former Bed Bath's bankruptcy. So it's the customers we're really focused on. We think the market will see the growth, top and bottom line, and reward us accordingly.
What about the ticker? Do you think that the ticker changes to be more in line with the new brand?
You know, people ask us about our corporate name and the ticker all the time. We intend to change both. We've mostly been focused on getting this relaunch and rebranding done. I expect in the coming months we'll have more to announce on the corporate name and the ticker, and let's make sure we talk again then.
All right. Well, we'll have some more vacuum questions for you as well, Jonathan, so stay tuned for that. Jonathan Johnson joining us, the CEO of Bed Bath & Beyond, on the rebranding. And coming up, Paul Taubman of PJT Partners with more on the hiring spree at the firm and the outlook for deal activity. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Bloomberg Markets. I'm Shonali Bassick with John Ehrlichman. Now, PJT Partners CEO Paul Taubman says any slowdown in deal activity is an opportunity to pick up new talent, and that's helped his firm triple headcount and revenue in the past decade. Here is some of my exclusive interview with him from earlier today.
We see tremendous opportunity to grow. This is an incredibly conducive environment to grow. You need to see M&A slow down in order to hire the best M&A bankers, and that's the ultimate paradox. And the reason for that, Shonali, is because the switching costs are much lower when you're dealing with a low-velocity environment. Trying to get a best-in-class M&A banker to leave in the midst of an M&A bull run when they're loaded up with a whole host of mandates, the switching costs to extract themselves, they end up leaving their clients in the lurch. So we're taking advantage of the fact that even though the environment is quite challenging in the near term, we know it's going to inflect, we know it's going to come back, and we want to continue to press forward and continue to grow the franchise.
How fast do you actually expect mergers and acquisitions to start coming back to the market?
The pace of activity and dialogue is clearly picking up. We're looking at levels today that we haven't seen in more than a decade. So M&A volumes today are not much greater than they were coming out of the global financial crisis. If you benchmark it relative to GDP or market capitalizations, it's at lows we haven't seen, I think, ever. So I'm not really going out on a limb by saying it's going to get better from where we are today. There's no doubt about that. It can't get worse. There's an old saying, you can't get hurt jumping out of a basement. I don't think, we are in danger of going lower than where we are today. The question is, how quickly does it inflect? And one of the things about M&A is it's a pro-cyclical business. Transaction activity begets more transaction activity. There's the ultimate FOMO, fear of missing out, which is if your competitor is transacting, if they're growing, if they're investing, if another private equity firm in the alternative space is committing capital, it tends to lead to more activity. I think we have the conditions that are nearly ripe for that. And it wouldn't surprise me if sometime between now and the end of the year, you see a very sharp inflection.
There is one place things could get worse, that is with restructuring. Higher interest rates, a whole bunch of forces that are pushing companies to either restructure or go bankrupt. How significant is this wave of distress going to be? What does it look like?
Well, I think we're in for an extended wave of elevated restructuring relative to where we are today. But where we are today is at historic lows in terms of default rates and the like. We're still feasting off of, the easy money environment, relatively low interest rates, but there's a day of reckoning, and we're going to see a meaningful uptick in restructuring activity. But again, to put it in perspective, that's relative to historic lows. And I often get asked the question, can an upswing in M&A coexist with an upswing in restructuring? And my answer is pretty simple, is right now, they're both at historic lows. We're seeing historically low default rates, and we're seeing historically low M&A volumes. And I think both of them can sort of snap back more to traditional long-term levels, and both start to be engines for our firm.
John, it's a totally weird environment where you have mergers starting to come back, but you also have this uptick in restructurings. It's very rare to see both at the same time, and he is now one of many investment bankers that are seeing this happen. The question is, those companies that go into restructurings end up into bankruptcies, or are they saved by private credit?
Big questions, but also big opportunity. I mean, it was a great interview, Shonali, and to the points that were made there, it's not every day that you can bring new teams on, and when the larger firms have obviously been going through their own restructurings, that's perhaps an opportunity at a time where we're also talking about new areas like renewable energy and AI, where it seems like some of these companies want to be ready to pick up on that new book of business potentially as well.
Yeah, no, what's crazy too is as technology companies, as AI companies, the capital markets are not open to everybody yet, so they're not hiring at scale. You have a company, PJT, not existing 10 years ago, getting 10,000 applicants for an internship program. So Wall Street is back, is it? Maybe not quite yet.
We'll be watching closely, Shonali, and we're also obviously watching the markets today, where we're seeing a little softness as August kicks off for the S&P after that 5-month winning stretch. Most sectors at this hour still in the red. We'll track those earnings stories. For Shonali Basak, I'm John Oliphant. This is Bloomberg.
What do you like most about your job? I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Blockbuster July for U.S. equities, giving way to a dog of a start to the month of August. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at how equities are doing on this first trading day of August. It's not too pretty. We've got 2 hours. We'll see how we end. But the S&P 500 currently off about 0.3%. Your big tech index only doing slightly better. You look at the NASDAQ 100 off by about 0.2%. In the bond market, meanwhile, you're looking at quite a sell-off at this point. 10-year Treasury yields higher by 9 basis points. You can see the yield currently trading above 4%. And then you take a look at crude, actually coming off a little bit, currently off by about 0.3%, Romaine, but still near the highest levels since April.
Yeah, maybe some of the tepid price action today has to do with earnings, particularly when we start to talk about, well, the durability of corporate earnings and whether they may actually be falling short of the pace of that equity appreciation over the first 6 months or so of the year. Several reports out this morning disappointing investors. That includes earnings out of Norwegian Cruise Lines, Rockwell Automation, as well as Zebra Technologies. You might not have heard of it, but it's a big maker of barcode scanners for retailers. But for every miss out there, there have been a few hits. Caterpillar, Arista, Oshkosh, all rallying today on strong forecasts that the companies provided this morning. After the bell tonight, we're going to get quite a few other companies, AMD, Starbucks, and of course, Katie's favorite, Match Group. Meanwhile, meme stock traders have found a new belle of the ball, Katie. Tupperware up a 5th straight day here. That's part of an 800% run over the past 2 weeks alone as investors pile into that stock, dinging short sellers, sparking a lot of excitement across retail trading platforms. Some of this related to Tupperware specifically, but a lot of this related to broader speculative FOMO sentiment, a long-only strategy out there that buys about 20% of the stocks in the Russell 1000 with the highest attention, beat low attention stocks by more than 5%. That's according to data compiled by Bloomberg Intelligence. And it's that type of speculation that is adding to more bullish calls for the broader market. Even with the recent pullback, strategists at JP Morgan's trading desk, Katie, they expect the S&P 500 to reassert itself around September before climbing to what they say is going to be a fresh all-time high.
And JP Morgan, just the most recent sell-side desk to come out with revised targets, maybe more bullish noises when it comes to the S&P 500 and the rally that we've seen so far this year. As you can see in blue here, this is strategists' year-end forecast for the S&P 500, the median forecast, and they've been having to revise that higher to try to keep pace with this rally. Of course, sort of reckoning with this rally, there had been a lot of bearish calls coming into 2023, and right now, even with this uptick that we're seeing, of course, it still implies for a fall in the S&P 500 by year-end. But even still, a little bit of a short squeeze going on among the strategist set. If you take a look at how Wall Street is actually positioned, how investors are actually positioned, there's still a net short out there. We're off the record short levels. Investors have had to capitulate at some level, again, to keep pace with that rally. It'll be really interesting to see in about 5 or 6 months, Romaine, where this ends up, because right now there's still pretty big short out in the market.
About the fear of missing out. A lot of talk right now, Katie. I guess, well, whether you do chase after this rally. Catherine Rooney-Vera joining us right now. She's the Chief Market Strategist over at StoneX Group, helping us kick off to the close. Always wonderful to see you, Catherine. Let's start off here with the rally that we saw in the first few months of the year, a rally that we now know was pretty much all multiple expansion. But there's now a lot of discussion about whether fundamentals catch up with that or whether it even needs to, given where we are right now in the Fed hiking cycle.
Well, if it's going to continue to be a multiple expansion-driven rally, then of course sentiment has to remain strong and earnings have to keep pace. I think the concern, and you highlighted this today, Romaine, is that they don't. So how are we protecting portfolios? We're saying, look, momentum is strong. Inflation base effects are good, are positive. The Fed is very likely on hold, maybe one more hike. It's irrelevant. The Fed is very close to its terminal rate. So what does that mean? That means that things are looking good, and they are. So the soft landing camp has definitely gained momentum with regard to recent economic data. I particularly like the combination of productivity. We're getting that data print out this week, and unit labor costs. If that flips positive in favor of improved productivity and we have real wage gains, this is very good for the U.S. economy. So stay long equities for sure, but protect yourself. And Romaine, my top trade right now is, given that volatility is so low, we're seeing volatility on the triple Qs, the lowest since 2021. That means that protection is cheap. Yeah. So the cost for that insurance is at its lowest in a couple years. Why not protect and buy puts on to protect your positions?
That's a great point, Catherine. I am curious as to why you think you haven't seen a little bit more of an embrace of that. And I guess some of this is just, we see this all the time, right? And when protection is cheap, people tend to ignore it. And when they need it most, of course, that's also when it's most expensive. Yeah.
That's counter-cyclical. That's why I published my piece last week, my first one at StoneX. And it was, the title of it was Counter-Cyclical Portfolio Policy. And the title, I think, is self-explanatory. This is something that our governments perhaps has forgotten or fallen by the wayside. But the idea is to protect yourselves when times are good. So euphoria is setting in. Analysts are upwardly revising repeatedly. Katie mentioned this, that they have to play catch-up. Fine, but the VIX is at 13. And there are a lot of headwinds coming into the fore. We are starting to see layoffs. Manufacturing is weak. Housing is going to roll over. The impact of a long and variable lag, we've all been talking about it. We have not yet seen it. So I would say that it's time to look at, in a boom, it's time to look for that cheap protection. Now I'm looking at puts on triple Qs, on S&P, cash, gold, sectors that have underperformed year to date because it's been such a bull rally and because the longevity of liquidity has lingered for so much. They are the outperformers in the next stage, which I think is economic downturn.
Well, Catherine, if you're protecting yourself in the equity market, when you take a cross-asset view, does that translate into a favorable view on bonds right now?
Yes, I do think there are opportunities in fixed income. If you look at the economic cycle, and this is an analysis that we've done in StoneX in-house over the past 4 decades, of course, large caps underperform in stagflation and recession. I think, Katie, this is a very underpriced risk right now. Remember 6 months ago, this was the consensus. We got it wrong. Timing is wrong, but that doesn't mean it doesn't come to fruition. So I do think that recession is part of the economic cycle, and fixed income needs to be a part of that. I do like at this point, or our rates desk is looking at bear steepeners, and I think there's some logic to that, especially if we're looking at a Fed that is close to its terminal rate, maybe does one more rate hike.
Maybe goes one more rate hike. And I want to talk a little bit more about stagflation. And in an environment, a stagflationary environment, should it descend on the U.S., what makes sense there? Does that argue for assets such as gold? How do you even position for that?
Well, in stagflationary scenarios, you can quantitatively prove, and we've done this at StoneX, that certain sectors tend to outperform, and those are the less sexy defensive ones. Those are utility and healthcare and staples and energy. So those are the same, and they share that phase of the economic cycle with recession. So one could argue we should be in stagflation now, given that we're still at growth rates that are below potential with sticky high inflation. But that has not played out. I think this year has surprised a lot of us, and it has a lot to do, I think, with the longevity, as I mentioned, the duration of liquidity that we're starting to see begin to dry up.
So we get to this idea here, Catherine, that as we work our way through the current economic cycle, and for that matter, the Fed tightening cycle, if we do end up, as most people expect, in recession, or at least economic conditions that would warrant some type of Fed rate cut, particularly into 2024 here, how much does that change, if at all, your general allocation thesis?
Well, the Fed's going to have a tough decision, Romaine, from my perspective, and I haven't heard a lot of people talk about this, but I think next year they're going to have to choose between rigidity with regard to their 2% target, and that could mean that they have to induce a contraction in consumption, or they could increase their inflation target or change it altogether. Do they cut rates before getting to 2%? They very well could. But I think that the most likely scenario is that we do see, even if it's a mild recession, we do see a rollover in what is consumption, given the long and variable lags of what I think is going to be the terminal rate of 5.5.
Catherine, always great to talk to you. Catherine Rooney-Vera there.
My pleasure. Thank you, Romaine.
Chief Market Strategist over at StoneX Group, helping us kick us off to the close here on this Tuesday afternoon. Coming up, a look at the messy effect on Major League Soccer here in the U.S., a discussion, a sit-down with the president of FC Dallas, Dan Hunt. That's coming up in just a bit.
Plus, Uber reporting its first ever operating profit, but revenue slightly missing estimates. We'll talk with Brad Erickson of RBC, who has an outperform rating on the shares.
And the summer of strikes here in the U.S., labor strife affecting companies including Yellow, UPS, and UAW. A conversation up ahead here about how that could potentially affect supply chains. All that and more coming up in just a bit. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, it's been a big day for U.S. economic data with the latest job openings and manufacturing activity out. And here to break it all down is Mike McKee. He is Bloomberg International Economics and Policy Correspondent joining us on set. And Mike, let's start with the JOLTS data, because looking at this, it seems like it's pretty good news for the Fed.
It is reasonably good news for the Fed, although the 9,582,000 job openings that still exist tell the Fed it's still a fairly tight labor market. It is progress in the right direction, falls from the prior month at 9,824,000. So not a huge drop, but enough that it tells the Fed they're going in the right direction. Quit rate fell to 2.4% from 2.6%, so the Fed's going to be happy about that. It shows people a little less confident that they can get a new job if they leave their current one.
Yeah, it's interesting. I mean, because you look at that chart and you think, okay, that's a sign of a relatively strong labor market, at least from the perspective of the workers. Again, not necessarily for the fight against inflation, but sort of overlay that with some of the other data that we're getting, particularly when it comes to manufacturing, which we know not quite as big of a component of our economy as it used to be, but it has to be concerning. What are we, like 9 straight months of contraction now?
Yes, for the manufacturing ISM, 46.4. It's a tiny little bit higher than it was last month, but the employment number falls down to 44.4 from 48.1. So it suggests that maybe companies are either not hiring anymore or they are starting to let people go. We'll find out Friday when we get the jobs report whether we're having an employment impact from manufacturing. But it does suggest manufacturing still has a ways to go to recover. New orders rose a little bit, but only to 47. So they're still below that break-even 50 mark.
Let's talk about Friday. Another jobs report. Feels like it comes every month. We're expected to see the unemployment rate hold steady at 3.6%. But when you look at some of the details of the report, what will you be keeping an eye on?
Well, unemployment is going to be a very important number because the Fed is expecting it to rise over 4%, Fed officials are. And if that doesn't start happening soon, it's not going to make it by the end of the year when they think that's going to happen. And the unemployment rate rising would be a sign to them that they are starting to push down on demand, and that would help balance supply and demand and bring down inflation a little bit more. We'll be looking at the job creation numbers, although they keep coming in higher each month than the estimates. The estimate is for 200,000. That's a slowdown, but that's still a very strong number in the long line of things. So that, and then obviously average hourly earnings, the Fed wants to see those come down a little bit. They're over 4%. They want them more in the 3 to 3.5%.
All right, Michael McKee there. A nice breakdown here of some of the economic data that we got today, of course, against the backdrop of a global economy that, quite frankly, has changed in a dramatic way over the last few years. It is our Bloomberg Big Take today, a look at how war, AI, and climate change are shaking up $32 trillion a year in global commerce. Bloomberg trade czar Brendan Murray joining us right now with a little bit more on that story. And Brendan, I think the pandemic, we know, sort of exposed a lot of flaws in the global supply chain, but there have been a lot of other issues that have also cropped up as well that seem to have just completely reshaped, I guess, just how goods flow around the world right now, if at all.
Absolutely. A lot of these trends were already happening before the disruptions that we've seen in the global economy, the shift to technology and climate change. And then you layer on the pandemic, Brexit here in the UK, the war in Ukraine, and businesses and governments are struggling to try to secure supply chains around the world. We hear a lot of buzzwords around this: reshoring, nearshoring, decoupling, de-risking. The U.S. and China are, that tight, huge trade relationship is coming apart. But what we did for this story is myself and 10 or 12 other Bloomberg reporters went out to visit these places that are the centers of the change that we're talking about, the disruptions: ports, borders, worker training facilities, factories, to see what's actually going on. And what we came back with is, I think, dispels a lot of the myths about this new phase of globalization, that it's not countries and companies retreating back to their corners and in a protectionist crouch. It's things are shifting around. Companies are moving to where they can secure those the goods that they need, and workers are retraining to adapt to the environment that they're facing as well.
What countries are benefiting from this? Because, for example, I mean, there's some fantastic reporting in this piece. It's noted that U.S. imports of tariff goods from China are down about $150 billion from where they'd otherwise be. Who's filling that gap?
So that's Bloomberg Economics has done a companion piece to the reporting that we've done, and Mexico is filling that void that's left with the demand reducing, the U.S. demand for Chinese goods taking a big hit from those tariffs. So places like Mexico, we've written a lot about Vietnam, where suppliers are shifting to become alternatives to China. India is also another big place that's trying to take advantage of this. We went to a factory outside of New Delhi and talked to the CFO, who told us, yeah, they're doing very well. They're making lots of assembling a lot of cell phones, but it's going to take years and years for them to scale up to a level that China will be. So that's one of the big takeaways. We're in for a long haul here.
But one interesting thing in the big take, Brendan, that I thought was interesting was about this idea that, okay, no matter what the relations are between a lot of these countries, there still has to be a flow of goods. And you singled out Morocco as kind of being in a very kind of geographic sweet spot, if you will, for funding a lot of those goods, at least into Europe.
Absolutely. So Morocco has this long tradition of aligning its commercial interests with both Europe and the U.S. Boeing has a big presence there. Airbus has a big presence there. European automakers have a big presence there as well. What we're seeing now is China wants to be in Morocco. So all the talk about the decoupling between the West and China, it's not happening in a place like Morocco. They're welcoming investment from everywhere. So what we're seeing is not globalization in retreat, but globalization sort of changing shape and shifting around, finding the path of least resistance.
All right, Brendan, got to leave it there. Really appreciate your time. That is Bloomberg's Brendan Murray talking about today's big take, all about the state of global trade. Now, coming up, Goldman Sachs sees its fifth partner depart in just the past week. We'll have more on the talent exodus facing the bank next. This is Bloomberg.
When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
All right, right, there is a talent exodus at Goldman Sachs. We've been reporting on that now for weeks, if not months, and we're now learning yet another person has decided to leave. Partner Lisa Opoku joining the growing number of executives to get promotions or get prominent new assignments over the past year, only to depart after getting those assignments. Sri Natarajan all over this story. And let's start off with Lisa. She was a partner of the family office, right? Leading that office, a job that she just kind of ascended to within the last year.
Yeah, and it was a very interesting role. It is a family office that is targeted at this captive clientele, which is the extremely wealthy executives who
I think that would
currently
be like
at
a
Goldman.
plum gig, right?
And the alumni, and Lisa Opoku is someone who was well regarded, had many senior roles at the firm. So in some ways, it is a bit of a blow to lose her. But again, they will tell you it's a deep bench. But in the last 4 days, we've seen at least 5 partners depart. And the broader context here is, it is very clear to anyone observing the firm, anyone talking to the executives at the firm, that there is this air of discontent that has settled over Goldman Sachs.
Yeah.
And it's not really clear how that immediately dissipates.
So I mean, we're putting up some, just real quickly, some names. Margaret Anadou, we've spoken to. Katie Koch, of course, had a reason to leave, to go over to TCW. Dina Powell, who knows why. Julian Salisbury, that was the most recent kind of big loss there, Katie. You're not on that list, Katie.
No,
but,
no.
These are some big names here.
Yeah, no, I definitely need to get hired at Goldman first before I can leave. But 3 is a trend, so I don't know what you call 5. What would you expect the response at Goldman to be? What are your sources telling you about how this is being received inside the bank?
So let's look at the fundamentals. We are just fresh of an earnings season where Goldman reported pretty bad numbers, just over $1 billion in profits. However, there is a silver lining there. That is not the regular run rate of Goldman Sachs. It is not going to be that bad in the forward quarters. And there is a reason the stock has actually bounced up after the earnings result, up some 10%, because they hope that there is some clearance in the forward. They have made some very visible and public strategic missteps, and they have promised to clean it up. They are promising to run a cleaner firm. Could have been done a few years earlier, but 5 years into David Solomon's tenure, at least they have gotten the strategy back on track. That seems to be the consensus among Goldman partners.
Yeah.
Now it's just a question of, will they remain satisfied with leadership? Will they be happy with the execution track that they're taking? And will they continue to back them? Because that support and loyalty is clearly frayed right now.
Is this something that's only unique to Goldman? I know we pick on them a lot, but I mean, look, anytime you get a lot of turnover at these big firms, particularly for people, like I said, some of these names, they've been there for a couple decades. At some point, you just want to see if the grass is greener somewhere else here. Are we seeing similar types of moves elsewhere?
And you're absolutely right about that, Romain. Let's acknowledge that Goldman as a firm tends to get more attention, and it's not just because we're focused on them. Anyone who's an investor, anyone who's in this space, anyone who cares about financial services seems to care about Goldman Sachs a lot. But at the same time, yes, there is churn everywhere else. We've just seen some interesting churn in the most senior ranks, not as aggregate terms. In fact, Goldman will tell you attrition levels, when you compare it on a firm-wide level or even across their partner class, isn't that bad. But there have been some prominent departures, some names who were plucked out of various positions and were on the ascent, clearly marked out as the next generation of leaders who've been leaving. And that's been the surprising aspect here.
Yeah, definitely a bit of underperformance here, at least over the past few months. Sri Natarajan all over this story with regards to the latest departure of a prominent executive from Goldman Sachs. Meanwhile, we take a quick look back here at the broader market, red pretty much across the screen. We should point out Dow Industrials are holding on to some modest gains on the day, but definitely some tepid price action today, Katie, as maybe a lot of people still waiting for a little bit more clarity on the economy and on earnings.
Tepid price action, nowhere really to hide right now. If you take a look at the bond market, for example, we were talking about that 10-year Treasury yield back above 4%, rising another 8 basis points today. Not a great start to the month of August, but it's early.
Yeah, I mean, it's early, of course, and you head into what is typically a lower volume type of month compared to what we get earlier in the year. But again, a lot of concerns about earnings. You had Caterpillar this morning. That definitely surprised to the upside. Norwegian Cruise Line surprised to the down. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Markets to Close, almost 2:30 here in New York. Let's get you caught up on what's going on in the commodity space. Abigail Doolittle standing by right now with our commodity close.
A bit of weakness remain on the day for sure. The Bloomberg Commodity Index overall down about 0.5%, but you can see some real weakness here for metals, gold, silver, and copper. So precious, industrial, silver being a bit of a blend, all down more than 1%. I suspect this has to do with the Bloomberg Dollar Index being up for a second day in a row. Right now up about 0.6%, fluctuating between its best day in about a week or its best day since March. That, of course, pressures metals in a big way. And then wheat continues to decline, down 2% today. This as Ukraine apparently has found other ways to export wheat, suggesting that the supply may increase more than traders had been counting on just a week or two ago, Romain.
All right, our thanks there to Abigail Doolittle. A look at the commodities space. Let's turn now to the world of sports, particularly the biggest sport in the world, soccer. Major League Soccer here in the United States getting a big boost from that man on the screen right there. Lionel Messi joining the Inter Miami team last month. His arrival expected to provide a big boost in revenue for the entire league as Messi plays around the country. One of his opponents, eventually, is going to be FC Dallas. Pleased to say joining us right now is the president of FC Dallas, Dan Hunt. Dan is also a member of the MLS Board of Governors and chairman of Dallas's FIFA World Cup 2026 host city efforts. Dan, great to have you here on the program. I won't pepper you with too many questions about Messi. I'm sure you're going to have to face him off at some point. But I'm sure you've got to be somewhat ecstatic about having a name like that affiliated with your league, a name that everybody, even if you're not a follower of soccer or football, you know exactly who he is.
Yeah, no, thanks for having me on today. Yeah, it's been amazing to have Lionel Messi join Major League Soccer. You're talking about maybe one of the greatest two players of all time, Messi and Pelé. And Pelé, you saw the impact that he had on soccer in America and the old North American Soccer League. I think Messi's going to have an even bigger impact. We're already seeing huge crowds come out to the games, and obviously I think the interest in our Apple TV package has just skyrocketed.
Oh, it's interesting you bring up Pelé. I was a kid when he came to, what was it, the Cosmos or whatever it was back in the day. And I mean, that really, at least for a lot of Americans, that kind of really put soccer on their radar. And now we've seen so many iterations of Pelé's, whether it's Lionel Messi or David Beckham or a few others that have come here. Do you think that the growth of MLS here in the U.S. is dependent on those international stars, or are some of the more homegrown stars also able to kind of carry this league?
Yeah, no, that's a great thought and great question. You know, we have been dependent in the past on that, but we're starting to see MLS really develop top local talents. And at FC Dallas, we do a great job of that. You look at the kids that we produced recently, like Weston McKennie or Ricardo Pepi or Brian Reynolds, who are playing in Europe. That's really the future of Major League Soccer. It's not just international stars, and obviously Lionel Messi is one of a kind. And you mentioned David Beckham, and you know I want to congratulate David and the Moss brothers on bringing him to Miami. But it's these stars that we're developing in our hometown markets. I think that's what American fans are going to really latch on to. And as the U.S. men's national team continues to have success, these are going to be the names that kids want to grow up and aspire to be like. They're going to want to be the next Ricardo Pepi or the next Jesus Ferreira. So I think it's just we're in this in-between phase, but I'm proud of what our partners are doing inside of Major League Soccer.
Well, let's talk about how big soccer could get in the U.S. because it's obviously the biggest sport in the world. But then you think about the U.S., and I haven't exactly checked these numbers, but I feel like it's basketball, football, and I don't know. I was going to say dressage, but I don't think so. Baseball, for example, that are the biggest sports. Do you think that soccer could get to a point where it's challenging the top three?
Yeah, I think the growth in soccer is limitless. My father, Lamar Hunt, before he passed away, told my brother Clark, we were visiting with him, and he said, look, guys, I will be gone, but in 50 years, he believed that MLS could be the size of the NFL, and it may actually come faster than that. And you think back when franchises were sold in the early 2000s, and we were below $4 million, and today the latest franchises are selling for $500 million within Major League Soccer, and then you have to invest $300 or $400 or $500 million in a stadium. So you see the growth for soccer. It's growing faster than any of the other professional sports. Obviously, the NFL, I think, is the beacon, although the NBA is fantastic, and you see the franchise values there. But as more and more young people are playing the game, I think it's going to just increase the interest throughout the United States. And look, let's be honest, the U.S. women's national team is arguably the greatest sports dynasty of all. And you have so many young women who are aspiring to play for the U.S. women's national team.
It's a great point, and I mean, speaking anecdotally, everyone my generation grew up playing soccer. It's really amazing. But let's talk about the World Cup in 2026. Of course, you chaired Dallas's efforts to bring it to the city. What kind of impact do you see there when it comes to finances on Dallas?
You know, we were talking about, you know, the momentum of World Cup 2026 before the Messi announcement, and there was a lot of interest in building, and you can't go, I mean, everywhere you go, everybody wants to talk to you about what it's going to happen with the World Cup, when they're going to select where the finals are going to be and semifinals and opening game. The corporate interest is unbelievable. We're seeing record attendance at FC Dallas, and we'll also hit our highest sponsorship number ever this year, and actually next year we'll surpass that. So there is all of this momentum building towards World Cup 2026, but honestly, the Messi moment has sort of bridged that gap, and now soccer is front of mind for the general public here in the United States. And frankly, what he did is we didn't need to be validated as a league, but what he did was show that, you know, MLS was ready to have the best player in the entire world. So I think soccer is going to just continue to grow, but the culmination is obviously World Cup 2026. And hey, let's not forget about that the Women's World Cup in 2027 is going to be in U.S. and Mexico. So this is a great time for soccer in this country and frankly on this continent.
I was curious too. I mean, I was looking at some of the valuations of these teams which have gone through the roof. I mean, I think Dallas FC at least is one of the fastest growing in terms of valuation. Obviously, the LA franchise at the top of the list there, but we're approaching billion-dollar valuations, at least for a couple of these teams, and most of the other ones now. I think the floor is basically right around 400 million or so here. How much higher do you see that going in the, I guess, short to intermediate term?
Yeah, we could sell more franchises now than we will ever take in the league, and that's been a big discussion at the league level is how big will MLS get? There is so much demand for these franchises, and all the time you're seeing different leagues selling, different teams are selling portions of their franchises to either private equity groups or individuals who want to get into sports. So I think there's limitless demand, but I don't know when it will approach NFL valuations. Obviously, the Redskins at $6 billion Dallas set a new high water mark in the transaction space. But MLS, these franchises one day will be in the multi-billions, I hope.
I am curious, and I just kind of want to end on a personal note here, because when I looked at sort of how Dallas FC came to be, the fact that you kind of came out of when the MLS, the original sort of iteration of this, was going through struggles, and of course your father was able to kind of pick this up for a song and turn it into something. But there was an interesting anecdote about his wife, your mother, who recently passed away, how she was the one who actually kind of got him into soccer, or at least showed him kind of the excitement of what it could be in the U.S. here. Is that true?
Well, my mother, Norma, was a Rotary Scholar at the University of College Dublin, so his first professional match was a Shamrock Rovers match in England, or in Ireland, and they were together doing that, and then the '66 final really is what gave him the energy behind starting professional soccer in the United States, specifically with the Dallas Tornado in 1967. But she was there along the way with the AFL-NFL merger. She was there along the way with the naming of the Super Bowl, also our family investment in the Chicago Bulls. She truly was the first lady of sports, and we all deeply miss her, but her influence will be felt for years to come.
Well, Dan, it's a good place to end it, and of course, condolences, and thank you for your time. That is Dan Hunt. He is the president of FC Dallas. Still ahead, Uber reported its first ever operating profit, and it shows customers still willing to pay a premium for the convenience of hailing a ride and getting food delivered to their door. We'll have more details next. This is Bloomberg.
Covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into ending record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Goldman Sachs, shedding its final bearish call out there with an upgrade to neutral over at Atlantic Equities. The analyst encouraged by stronger Q2 results, but still says the firm still has some roadblocks out there, including concerns about the Apple Card and volatility in its major revenue streams. Though the price started getting bumped up to $350 from $330, shares only up 0.1% on the day. Next up, let's take a look at Morgan Stanley, sticking to their guns on data storage device maker Western Digital, reiterating an overweight rating and maintaining a $52 price target. The analyst saying that while business conditions are poor, they are stabilizing, and the company has been executing well. All right, and let's end on American Eagle, upgraded to overweight over at Barclays, with the bank turning bullish on the entire retail sector. The analyst saying inventory improvements, cooling inflation, that's going to give some customers a little bit more wiggle room to spend on that apparel. And investors, well, they should look at any weakness in the coming months as an opportunity to buy the dip. They're doing that today, 4% gain on AEO, and those are some of our top calls. Let's pivot from that and talk about Uber, the company actually reporting its first ever operating profit, and believe it or not, that's on a GAAP basis. The results have raised the bar for Uber moving forward. The CEO, Dara Khosrowshahi, joining Bloomberg Technology earlier. Take a listen as to what he had to say.
We're very excited about this. It's a seminal moment for Uber to deliver GAAP operating profit, free cash flow of over $1 billion just in the quarter, along with a really strong top line. You look at a gross bookings growth that was $33.6 billion.
All right, Dara Khosrowshahi there. Now let's get some insights out of Brad Erickson, RBC Capital Markets senior analyst with an outperform rating and a new price target of $58 a share. And Brad, let's just start off. This is a company that for the last couple of years has really seemed to make profitability much more of a focus than what it had in the past.
Yeah, that's right. Originally when these guys came public, which was kind of mid-2019, right, we were great guns around growth. Profitability certainly was expected down the road, but wasn't needed quite as imminently. And then, obviously, as we went through COVID, the business took its lumps, significant lumps in this case, around the impact to travel, and they had to initially cut a ton of cost out. Coming out of COVID, the rise in rates, the increase in profitability, now we've had to step that up further, and frankly, they've over-delivered really through this period, so they continue to track very well along those lines.
Are you, I guess, pleased, though, with the way that they're achieving this? I mean, when everyone was looking at the operating profit numbers, sort of the joke around the newsroom here was like, oh, it's actually on a GAAP basis. It's not just, the adjusted, EBITDA metrics that they always want to give us here. It seems to be going in the right direction, but at the end of the day, Brad, we also know that investors want a growth story. Is there a growth story to be had?
Absolutely. I mean, they just put up order growth over 20%, even laughing some tough comps from last year. So I think absolutely the growth story is there. I think, the formula here, it may sound a little bit trite, but what they're really doing with membership and other verticals, grocery, convenience, on top of restaurant delivery and the mobility service everybody knows about, they're adding gross profit dollars, right? More gross profit dollars against kind of a fixed cost base. That drives leverage, that drives earnings growth, and we think that can sustain for the next several years.
Let's talk about where delivery puts it in competition to some of its peers, for example. I noticed you also cover DoorDash. You have a hold rating there. How dominant could Uber get in that segment?
I think I would regard the two players as relatively equal. DoorDash is ahead of Uber pretty meaningfully on a market share basis, but I think lately things have been fairly stable. I think they even mentioned this morning they kind of held share in the quarter in food delivery. So, they're all pursuing the strategy and that opportunity, certainly here in the United States, and now DoorDash acquired a company over in Europe last year, and so they're being more active over there as well. But I think in general, the food delivery opportunity combined with grocery, combined with convenience, and really combined with any other sort of local merchant that would want to allow for on-demand sale and delivery, that opportunity is still really big and really underpenetrated. So I think there's more than enough room for both of them to continue to pursue that opportunity well in the future.
Pie is still big. And Brad, it's hard to have a conversation about Uber without mentioning Lyft. And of course, Lyft takes the stage next week in terms of reporting its earnings. How does what we learned from Uber today set us up for that Lyft report?
Yeah, so a couple things, and we of course do our own work on this, and I think what Uber kind of came out with today squares with what what we were thinking, which is, Uber's been really consistent on price. Lyft has had to drop price to get more competitive in the last few months. Now they're kind of more or less priced the same. And I think what we learned today is that Uber isn't really giving up any ride volume market share, even as Lyft has gotten more attractive on price. So, we have a hold rating on Lyft. And what I would say there is I think the top line results are going to be fine. I think what's held us back on Lyft historically and continues to is that, from a P&L standpoint, they don't have food delivery. They don't have some of these other grocery convenient type situations. And then Uber's business is just so much bigger. That's a ton of diversification for the P&L when you think about things like driver incentive costs, insurance costs. These are the things that have weighed on Lyft's profitability. And frankly, we kind of expect those headwinds to continue.
Brad, great to catch up with you. Brad Erickson there, RBC Capital Markets Senior Analyst. Absolutely, a closer look there at Uber. Let's take a closer look right now, Katie, at auto sales here in North America. We are getting the latest results here for July auto sales. Still waiting on some of the big U.S.-based car makers like GM and Ford, but we already got some of the Asian car makers already. Honda reporting July U.S. auto sales were up 57%. Hyundai's auto sales, the percentage wasn't quite as dramatic here, but they did say it was their best July ever for North American retail sales, about 62,000 retail units sold. And Kia also reporting some pretty good numbers, and some of the EV makers out of China also reporting good numbers as well.
Yeah, the Honda numbers really in a league of their own. Just to say that again, U.S. auto sales for July, 56.9%. Pretty amazing. And we talk about the housing market and how strange it is right now all the time, but you think about the auto market, both the new and used cars, really interesting as well.
Interesting as well, and it gets to this idea too of sort of what people are buying. Like I was going through some of the numbers, so like just take Hyundai. On a percentage basis, in terms of percent increase in sales, what model do you think did the best? This is a pop quiz.
Any answer for you? Not a car gal. What did it?
It was an Elantra, which is actually one of their more, it was up 42%, one of their more, I guess, affordable vehicles. It's a sedan, but it gets to this idea too that, you had SUVs obviously dominate with GM and Ford, and obviously everyone's trying to make EVs a thing here. But at the end of the day, EVs aren't really driving this, and at least for and this, we should point out, this is just for the Asian automakers right now, and not even SUVs. Right now it is basically just your family sedan. Kid.
Yeah, casual. But I think that's a good point about EVs. And it's going to be interesting to see how that changes over the next decade. But some really fascinating numbers, especially Honda. I'm still stuck on it.
All right, a look at auto sales here. Passenger autos up ahead. A look at the trucking industry here. We learned about Yellow basically shutting down. This, of course, comes on the heels of the Teamsters actually voting to strike. And now a lot of concerns here, not only just about the truckers, but about the health of our supply chains. Jason Miller, a professor of supply chain management at Michigan State, going to be joining us in just a second. This is Bloomberg.